I'm Shauna Smith alongside Madison Mills, and this is Yahoo Finance's flagship show, The Morning Brief.
Futures mixed this morning as tech stocks looking to make a small comeback from the Nasdaq's worst day since 2022. Better than expected earnings helping investor sentiment, but the other big driver of markets right now, the great rate cut debate. We'll be speaking with Chicago Fed President Austin Goolsbee at 10 a.m. Eastern about the Fed's path forward. So let's get to it with the three things that you need to know for this Thursday morning. Yahoo Finance's Jared Blickery, Alexander Canal, and Rick Newman have more.
Big tech is looking to claw back Wednesday's losses after the Nasdaq Composite suffered its biggest single-day decline since 2022. The sell-off was sparked after a Bloomberg report claimed the Biden administration is mulling plans to impose more sanctions on Chinese tech firms. But a stronger than expected quarter from Taiwan Semiconductor looks to have steadied markets 30 minutes ahead of the open.
Plus, Netflix is set to kick off big tech earnings after the markets close today. And the bar is already set high as shareholders praise the company's foray into live sports and live events. The company has also benefited from raising prices on its ad-free subscriptions in an attempt to lure more users to its ad-supported tier. The stock is up more than 30% since the start of the year.
And Ohio Senator J.D. Vance formally accepted the vice presidential nomination at the Republican National Convention on Wednesday night. Former President Donald Trump had tapped Vance as his running mate a few days prior. In his address, Vance touted Trump's economic agenda and called out Wall Street for crashing the economy. Trump is set to take the stage later tonight to accept the Republican nomination for president, providing a glimpse of what the economy could look like under Trump and Vance.
Let's take a look now at futures here. Looking at a little bit of downward pressure across the major indices, though I think this might be what we were seeing yesterday in the broader market here. If you take a look at what we're seeing in the futures space, earlier we were seeing at least the Dow moving to the downside here, the S&P and the Nasdaq recovering ever so slightly. You can see here, thanks Shauna, the S&P up about 0.3% in your pre-market trade here, recovering a little bit after the sell-off that we saw yesterday. The Nasdaq closing down over 2.7% in one of its worst days in over 350 days. So really a tough day given some of the downward pressure that we saw, particularly in those chip stocks, but seeing a little bit of recovery, at least in the pre-market here.
Yeah, exactly. And as you can see on your screen, this is actually where we closed the day yesterday. So lots of red on the screen there. You got NVIDIA off just around 6.5%. But flipping over to the extended move and really what we are seeing here today, and those are the smaller numbers up here on your screen. And you can see we are seeing just a bit of a comeback, better than expected results from TSMC, really driving this morning's reaction. You've got that stock up just around 3.5%. You've got Broadcom up nearly 2%. NVIDIA, which has been the market darling this year, we talk about it time and time again. Yes, yesterday, horrible day for NVIDIA. We have seen it on a bit of a roller coaster ride over the last several weeks, but again, recouping some of yesterday's losses, at least half of yesterday's losses, ahead of the bell, on track to at least up just around 3.3%. So again, some trades to keep in mind. When we flip over inside the Dow here and some of the Dow components, now we did note that the Dow actually closed the day to the upside yesterday, and we are seeing lots of green on your screen. Actually, it's a bit of a mixed picture here, but you do have Amazon, Apple, and Microsoft here moving to the upside. So again, that larger cap tech trade back in favor, at least for now. And I think what investors were really, and what we were talking to strategists about yesterday, was whether or not the rally in big tech was over. And that seemed to be more and more of the sentiment here, a growing consensus. But again, when you look at moves like today and some of that clawback that we are starting to see, I think people are starting to second guess maybe there is more room to run to the upside.
Buy across the board, I guess.
Buy across the board. All right, we'll see. Well, Nasdaq futures showing signs of that rebound that we've been talking about. They're sliding over 2.5%. Now, to discuss if it's time to shed some tech or if there's still room to go to the upside, we want to bring in Brian Jacobson. He's IXIC Wealth Management's chief economist and strategist. Brian, it's great to see you. So let's start with tech. It's top of mind here for investors this morning ahead of the opening bell. Where do you stand on whether or not investors should be adding to their tech positions at this point?
Yeah, thanks for having me on. And we've been discussing this on our investment committee here at Annex actually for a while as far as what type of overweight or underweight to have to tech. If you look at the distribution of valuations within the tech sector, because it covers a wide variety of different types of companies and industries, we were really most concerned about with the chips stocks, right? People were looking at it that is this a trade for now or forever that you kind of just want to hold them and just let the earnings, the fundamentals really kind of push the prices higher. We were a little concerned as far as the valuations. There could continue to be a little bit of a repricing. So we wouldn't necessarily view this as a buy on the dip kind of opportunity here with the chip stocks. We do like tech in general. If you think about like the software companies, the ones who manage the data centers, the ones who are providing the electricity, all the plumbing that goes into them. And so it's really a broad ecosystem that we think you can kind of think about. But in terms of the chips themselves, this highlights political risks that are out there. It wasn't the fundamentals that really disappointed. It was the shock of the politics.
What does that tell you, Brian, about the likelihood of this earnings season to be driven by company fundamentals more broadly or by politics? Do you think that that is a story that's going to continue throughout this cycle?
Thankfully, we think that actually in the near term here, it is mostly about the fundamentals. But then as we get into, say, 2025, it is going to likely be a little bit more about the politics. So it will almost be punctuated by political volatility. The fundamentals we think are okay. But keep in mind, it's a matter of how much do you pay for those fundamentals. If you look at a couple examples, like we were looking at, say, Microsoft, for example. It's a stock that we've held for quite a long time. Fundamentals look good, but then you have to ask, how long would it take for it to have decent growth to really get back to what you might consider historically normal valuations? That could be like 10 years. So a lot of the gains that we've seen over the last year and a half, maybe we're anticipating the good growth of the fundamentals going forward. So this earnings season that we're going into, we think it's actually going to be okay for, say, small, mid, and even for the tech sector in general, because the fundamentals are holding up. It's more about the price that you're paying for those fundamentals. And that's where I think there's a lot of questions and some of the vulnerabilities out there.
So Brian, then given that, are you buying small caps? And I guess when we talk about even beyond earnings, you were saying that, hey, maybe we are going to get stronger results this earnings season. What is it going to take to keep some of this momentum that we have seen in the names that had been left out to dry over the last several quarters? What's it going to take in order for those to stay in favor?
Yeah, I think it is really about the earnings, the reports that come in. We have increased our allocation to small and mid relative to the large cap space, more in what you could consider the cyclical areas like, say, industrials, but coupling that with some defensives like, say, healthcare and consumer staples, mainly on a valuation basis as far as where do we want to be for the longer term, taking this opportunity of the past underperformance of those sectors and those market caps in order to position for what is hopefully longer term success. And so when we go into earnings season here, we're really expecting that some of those smaller cap names, they're going to start emerging from this repeat recession that they've been going through. If you look at the quarter by quarter earnings of small cap and mid cap over the last 2 years, they have not really had a string of more than 2 quarters in a row of increases in earnings per share. And that just shows and it highlights the struggles that some of these smaller companies are having with high financing costs and weak pockets of growth for the markets that they serve, whether it's lower income individuals or if it's exporting to Europe, where you've seen lower growth. Most of the great growth has been in the mega cap space.
Brian, when you talk about earnings being so important here for the market, you've also got Fed decisions, and then looking ahead to November, you've got the elections. I'm curious, what is the biggest driver of the market, do you think, between now and year end?
Yeah, I think between now and year end, it's going to be broken into really 2 different parts. Between now and September, it's likely more focused on the Fed. We will get distracted by politics, but really until we get closer to, say, end of September, beginning of October, when the polls are going to get a little bit more accurate, we think that those are just going to be like pockets of volatility. The Trump trade came back in vogue with a vengeance over the last week or so. but that could kind of simmer down a little bit. Now focuses more on the Fed about whether or not they're actually going to cut in September. We think that they likely will, probably at an every other meeting pace. You'll be talking to Austin Goolsbee later, and so I'm going to be tuning in for that because I think he's a great guy to listen to as far as sort of how to think about what the Fed is thinking. Then when we get into October, it is more about the politics. It's more about policies. Keep in mind, November and December tends to be a very good time. You tend to get a relief rally for the markets. So we would be looking at stay diversified, but if you're looking to put that cash to work, we should have a few opportunities between now and the election in order to deploy that capital.
Brian, we love when we have guests promote our own show. Thank you so much for joining us and for the great insights as well. We appreciate it. That was Brian Jacobson, Annex Wealth Management's chief economist and strategist. Moving on to some company news, because Netflix is set to report its second quarter earnings after the bell. The stock is up over 30% this year as investors praise the streaming giant's push into sports and the success of its ad tiers. But can the rally for Netflix continue? Yahoo Finance's Alexander Canal has a breakdown of what investors should be looking out for. Allie.
Hi, Maddie. Yeah, so Netflix is really the start of big tech earnings. So one of the first things I'm looking out for is the stock reaction following the results, especially given that high valuation that you just mentioned. At Wednesday's close, Netflix traded at just over $647, which isn't that far off from its record close of $691 a share on November 17th, 2021. So the company will be faced with a pretty high bar as those expectations remain elevated. Now, this has caused some apprehension on Wall Street, with analysts saying a lot has already been baked into this stock. But Morgan Stanley's Ben Swinburne said, quote, "We remain bullish given there's still large opportunity for growth ahead." And speaking about growth, that's another thing to watch out for tonight. Any updates on those growth initiatives like live events, live sports, that's all going to be closely watched, especially when it comes to other potential opportunities. Management has consistently maintained that the acquisition of those NFL games doesn't change its stance on sports rights, but we have seen this company pivot before, so something to potentially look out for on that call, along with further updates on the advertising tier, the password sharing crackdown, and any future price increases, as that all really impacts top line growth. And then finally, something I've seen circling around is whether or not Netflix will announce a stock split, given the stock is flirting with those record highs. We've seen it from some other big tech names, so maybe, just maybe, Netflix could follow suit. And guys, I think it's pretty safe to say if that's announced, it's going to send shares way up no matter what happens with those earnings. So a lot to keep an eye on heading into the second quarter report, all coming up after the closing bell.
All right, Allie, we look forward to your coverage on that. Thanks so much. Again, Netflix, a name to keep on your radar here today through the closing bell. Well, Senator J.D. Vance accepting the GOP's nomination for the vice presidency at the Republican National Convention. During his speech, Senator Vance looked to win over the working class by blasting Wall Street.
Wall Street barons crashed the economy and American builders went out of business. As tradesmen scrambled for jobs, houses stopped being built. The lack of good jobs, of course, led to stagnant wages. We're done, ladies and gentlemen, catering to Wall Street.
We'll hear from former President Donald Trump today, where he will accept his nomination as the Republican nominee. For more on what we want to hear tonight, what we might hear tonight, Yahoo Finance's very own Rick Newman is here. And Rick, when we talk about what we could hear from Trump, I'm just curious your reaction to what we heard from Vance last night, obviously sticking to many of the talking points that we had anticipated him to do and really doing everything he can, it seems like, to win over that working class.
So those clips you played, when I heard him say that last night, I had to stop for a minute and ask myself, what exactly is he talking about? Wall Street has not crashed the economy lately. The economy is actually doing pretty well. I mean, we're hitting record highs in the stock market until recently. I think he's talking about 2008, when, by the way, George W. Bush was president. He's talking about the housing bust. And then he says, we are done catering to Wall Street. Is he saying that the Biden administration is catering to Wall Street? I don't think so. Biden wants to raise the corporate tax rate from 21% to 28%. So my takeaway here is these are talking points that might sound okay to some voters. In reality, the Trump campaign is kind of doing the opposite. They are actually sort of catering to Wall Street. Trump wants to cut the corporate tax rate, not raise it. He reportedly told oil executives earlier this year that they could have any policy they want. under a second Trump administration if they could raise $1 billion for his campaign. And we've got tech moguls like Elon Musk, who seem to be the people who put J.D. Vance into the vice presidential role for the Trump campaign. So we're going to get more, obviously, from Trump tonight, and then we've got about 4 months of campaigning to go. But those were some curiosities, let's say, of J.D. Vance's acceptance speech.
I also want to talk about President Biden testing positive for COVID-19 as we continue to hear reporting about calls for him to step down. Right now, a lot of those calls are private. We're hearing reports that Biden is becoming more receptive to those calls. Do you think that his COVID diagnosis potentially leads to those calls becoming more public from officials looking for Biden to step down within the Democratic campaign?
I mean, Biden obviously is having a terrible summer, and it's like catching COVID when everybody else is out going to the beach and going on vacation. It just sort of symptomizes what's wrong with the Biden campaign. The latest reports here, I mean, it's been a drip, but the latest reports are that senior Democrats now, including Hakeem Jeffries, the minority leader in the House, and Chuck Schumer, the Senate Majority Leader, are basically telling Biden that if he continues to campaign, if he's the nominee, he could bring down Democrats in both houses of Congress, and we could have a Republican sweep. And reportedly, Biden is now thinking a little bit more that he needs to take this seriously. Some analysts think the dam is breaking. Biden, however, is extremely stubborn and very proud, it's worth saying. And we'll see what happens. I mean, I think we're probably above 50% likelihood that Biden withdraws. It's going to happen within the next 3 weeks or so, I would say. So once the Republican convention is over, I think that's going to be the big political story.
All right, Rick, always appreciate your insight. Thanks so much for hopping on with us this morning.
Bye, guys.
We're just getting started here on a morning brief. Results from Taiwan Semiconductor showing positive signs for the chip space following yesterday's sell-off. You're looking at gains of just about 3% ahead of the open. We're going to break down that and other top trending tickers next. And Domino shares are sinking after warning of fewer store openings. Lots of concerns about their guidance. Despite all that, we're going to hear from an analyst who still says that you should be encouraged by a number of metrics released within this report. And stay tuned for our 10 a.m. hour of Catalyst. Jennifer Schomburger will be speaking with Chicago Fed President Austin Goolsbee, where she'll be getting his latest thoughts on the Fed's rate cut timeline. All this and more. You're watching Yahoo Finance. Time for some trending tickers. Taiwan Semiconductor beating expectations in its latest report and raising its full-year revenue outlook, fueled by confidence in AI demand. The chipmaker CEO saying on an earnings call, quote, "This time AI demand is more real than 2 or 3 years ago." This comes just a day after reports of potentially tighter trade restrictions from the U.S. sent chip stocks lower. We're seeing a bit of a clawback there of those losses that we had seen in yesterday's session. Again, you're looking at gains of just about 3%. But digging into this report, lots of strength. They recorded 40% sales growth here for the quarter, raising their full year growth outlook, revenue growth outlook, to be in the above the mid 20% range. We mentioned the commentary from the CEO in regards to AI. Well, the company actually saw high performance computing, including AI, contributing to 52% of TSMC's revenue here. And that is significant because that marks the first time that has happened, that it's accounted for more than half of the revenue there going forward. So, Maddie, that really speaks to the insatiable demand that we have seen for AI, this willingness, this CapEx willingness here from companies to spend on their AI efforts. And a name like Taiwan Semiconductor clearly reaping the benefits of that.
Absolutely. I think it's interesting to take a look at beyond the stats that you mentioned for TSMC, and obviously the growth that TSMC has, contributing 90% of the world's most advanced chips. When you get a report like this with such strong earnings, that's going to move the companies that are utilizing and being the customers of TSMC. So that is why we are seeing a turnaround in some of these chips names in the pre-market trade here. You're looking at shares of NVIDIA moving strongly to the upside, up over 3% in the pre-market here. I also mentioned to you, Sean, I was surprised at the degree of the upside that we were seeing in Intel. That is one of the companies that's going to be a beneficiary of the commentary that we saw both from President Biden and former President Trump about bringing production stateside. This is a company that already has the chokehold really on U.S. production. Meantime, you've got TSMC working on building plants in Arizona. That's going to cost them over $65 billion, but that takes time. And that is part of the broader discussion we've been having about bringing production stateside and the expense and time that that's going to take. Well, moving on to airlines here, because we're taking a look at the airline sector as shares of United Airlines up a little over 1.5% here, but the stock did initially fall 1% on the back of its profits coming in below expectations, though they did jump more than 20% for the quarter. We've got another story like that with Alaska Air forecasting full year profits below expectations. That stock is down 2.5% in the pre-market trade. So here to discuss what this means for airline stocks, we've got Tom Fitzgerald, TD Cowen Vice President covering the aerospace. Tom, thanks so much for being here this morning. I want to take a little bit of a step back because we're hearing this word overcapacity from a lot of the airlines, that they've got too many seats, they're not filling them. I'm not seeing that when I am on flights right now. It does not feel like overcapacity. What is the disconnect?
Yeah, I think it's primarily in the main economy cabin. There's just too many main economy seats chasing not enough leisure travel. And I think what we've seen is with corporate travel plateaued and having a very gradual recovery, the full service carriers, the Uniteds, the Deltas of the world have moved more into those traditional leisure markets, and they're doing that with a much better product, competitive wise. You know, they've cracked the code on basic economy, and they're really, you know, they're taking advantage of their loyalty program to offer consumers aspirational travel, and they're leveraging, you know, investments to make, you know, to run a more reliable operation that just give consumers, you know, consumers are voting with their wallets, and they're choosing those carriers. And I think we're entering a really interesting fork in the road moment where the weaker players, the players who are flying a lot of loss-making routes, are going to have to retrench or raise prices, and that's going to be a great opportunity for the Uniteds of the world to take share and continue their upward trajectory.
Tom, more specifically, what does that opportunity look like then to take share? And how big of a catalyst do you then see that being for United stock?
Yeah, I mean, it will vary market to market, but, you know, you could see, you know, ULCCs just flat out just pulling out of markets or significantly cutting back, and United will be, you know, the only game in town. Or you could see, you know, Southwest does, you know, launches baggage fees, and, you know, maybe they get some incremental revenue, but they could also destroy a lot of demand because there's many customers who choose to fly them specifically for the bag fees, or not paying bag fees. So, you know, we're interested today in the call to kind of get a better sense of management to see how much volume they think they could capture over the next, you know, in the coming quarters, and you know, get a better sense of what gives them the confidence that they expressed in their prepared remarks that that their competitors will pull back. We're seeing a lot of capacity cuts starting in mid-August, but we're hoping to get a better, more granular data on what they're seeing out into the fall, and just because the industry, there's been other times when the industry has talked about rationalizing capacity, but then hasn't ended up finding religion. So.
It's interesting, Tom, because the airline sector is one of those that we look at for an indication of how the consumer is doing more broadly and as an indication of what we might see from more consumer names throughout the earnings cycle. When you talk about the management challenges, for example, do you see the struggles that some of the airlines are experiencing as idiosyncratic, or is it indicative of a struggling consumer?
I don't think it's indicative of a struggling consumer. I just think the game changed a lot. I mean, United has talked about this a great deal. We've written about it a lot, but the cost convergence is just the low cost carriers, the ultra low cost carriers. They're just at such a disadvantage point from a competitive wise, and they're just not. I think people coming out of the pandemic are much more willing to pay for a more pleasant onboard experience, to pay for a more reliable product, to earn loyalty, or to earn miles in an airline where they can redeem to go to Europe or something, versus just another low-cost leisure no-frills carrier.
Tom, do you think that this is the theme that we're going to hear this earnings season when we talk about the fact that the inability of some of these lower-cost carriers to fill the seats, and then obviously having to adjust pricing? It seems to be weighing, obviously, on the entire sector. How long do you expect that overhang to exist?
I think I think you can only continue to post deep losses quarter by quarter for so long. People will only underwrite that for so long. I think we're getting as major debt maturities start to come current. I think that's gonna be cause the inflection point. And I think the next month, 60 days, this quarter is going to be very fascinating for the industry. I think many carriers might hit an air pocket, and I think by the time we get to November and United and Delta are having their investor days, I think we'll have a much better sense of what that fork in the road looks like and how the wheat will separate from the chaff. And I think they're going to have a great story to tell investors come November, and really set up the shares well for a re-rating as long as the economy hangs in.
All right, Tom Fitzgerald, great to get your insight here on the heels of these results.
Thank you.
Great to talk to you. TD Cowen's Vice President covering airlines industries. Thanks so much. Warner Brothers Discovery is reportedly drafting a plan to split its business. The media giant's mulling separating its streaming and studios businesses from its television networks. This is according to a report out from the Financial Times. Now, the company grappling with $39 billion net debt load, and it's that debt that's really been the focus here of the street. But as you can see from the pre-market reaction to this report, it looks like Wall Street is a bit encouraged by what exactly this would ultimately mean here for Warner Brothers going forward. Now, within this report, in regards to that $39 billion of debt. Now, the Financial Times saying that sources saying that $39 billion could remain with the pay TV networks business if Warner Brothers Discovery were to break up. Now, CEO David Zaslav is examining several options for the company, according to this report, all in an effort here to boost the stock price here going forward. The stock has struggled for quite some time. We have the one-year chart there up on your screen with shares off just about 32%. It's media week here at Yahoo Finance. We've been talking a lot about the consolidation that we have seen, at least when it comes to Paramount, but then also really more so what we are expecting to see in the coming quarters, given that there are by far leaders within the space versus the laggards. And in order to really excel, it seems to be at least consensus from the street, we will likely see more consolidation as a result.
Yeah, it's smart of you to bring up the debt challenges, because this breakup could, as you mentioned, lead to a scenario where the debt could remain with the pay TV networks, which could be a positive for the business here. We should mention, though, we don't have any reporting about Warner Brothers Discovery hiring a bank to initiate any of these deals. If we do get news of that, that would be a sure sign of some M&A to come for WBD, even though we know they are eyeing this split of the streaming and studio units. Hiring of a bank would be a key kind of catalyst to indicate that that is a little bit more serious here, but that potential breakup is indicative of some broader themes that we are seeing in the media space here.
All right, we've got the opening bell here in just a few seconds. Again, a bit of a reversal, it looks like, is going to be underway on Wall Street as we do ring that opening bell at the Nasdaq and the New York Stock Exchange. A shift in sentiment when it comes to the chip makers. We're seeing outperformance here at the open among many of those tech stocks. Now, this on the heels of TSMC, Taiwan Semiconductors, raising their revenue outlook. A lot of that reflecting the demand that we have seen for AI. We also got some econ data out before the bell this morning. Jobless claims spiking more than we have seen, really pointing to some weakness maybe within the labor market. So reinforcing maybe what the street wants to see when it comes to expectations for a Fed rate cut soon. Again, so we're seeing that play out here. The S&P and the Nasdaq opening here to the upside. You've got the Dow, though, reversing some of those recent gains off just around 110 here at the open, Maddie.
Yeah, those jobless claims also putting some pressure on the yield space, falling off of those jobless claims. As to your point, the market looks ahead to those Fed rate cuts. But we're going to get to more with Yahoo Finance's very own Jared Blickery for a look at what is moving. Hey, Jared.
Hey there, Maddie. You know, the Dow and the Nasdaq just can't agree lately. And today we have the Dow down about 1/3%, while the Nasdaq is up 0.7%. And let me just show you what has happened this week so far. A 4-day chart. Here's the Dow up 2.67%. Here is the Nasdaq going in the opposite direction, down 1.5%. So what's going on? This is sector rotation, the lifeblood of the market. We are getting away from that concentration that we had. So the Mag 7 not doing that well recently, but the S&P 493 really stepping up here. And we can see some of these new sectors that have really just shown a lot of strength recently, even boring staples. Let me just show you what happened to consumer staples recently. This is a 3-year chart, and it is just now breaking out of this high. We had a record high, I believe, only yesterday. And then you take a look at what's happening in industrials, another break to the upside there. You can take a look at healthcare, which is down today, but that also broke out. So we have a lot of exciting things to think about here, but definitely over the last few days, what has not worked, well, it's working today, these are the chip stocks, but let me just show you the 5-day total here, and you can see a vastly different picture. So even though we're seeing this zigzag action, the net effect on the market is it reduces volatility. And we also have a trending dollar that's going to the downside. That is a tailwind for equities. There's really not a lot standing in the way right now outside of a surprise. And so I think, you know, we're looking at earnings and then also the Fed next week. So we'll see what happens.
We'll see what happens. Jared, great stuff. Thanks. Well, coming up, more results from the healthcare sector. We're going to break down why both Abbott Labs and Novartis are moving to the downside here at the open. You're looking at losses of about 4% here for both of those stocks. More on that when we come back. Abbott Labs raising its full-year profit forecast, boosted by sales in its medical device unit. That grew about 12% from a year ago in the second quarter. Shares, though, moving to the downside here this morning. It's off just about 4% shortly after the open. Anjali Kamlani has been digging into this report, and it looks like, at least on the surface, it was actually pretty strong here from the company.
It was, yeah, on the surface. And I'd also like to point out, in particular, in addition to the upgrade, we also saw really strong numbers for their Freestyle Libre. That's their continuous glucose monitoring device, and that's one of the specific products that I've been keeping an eye on, especially in light of the GLP-1 boom. We know that those types of devices had been sort of under pressure, and there's a sort of doomsday prediction for them, but you see growth 20% year over year for that. The only downside we saw was the reduction of COVID-19 tests, which of course is impacting all stocks related to COVID in the waning of the pandemic era, even though we are in the middle of another wave right now. But really the story for Abbott is pretty solid in terms of the growth across all business divisions. Their nutrition was also up, driven more by the adult side rather than what we've known in the past as their baby formula side. We know that has taken a hit in the past, barely beating, but just by a hair on the estimates for revenue, and then really good on the adjusted EPS, as you can see on your screen. So the numbers there tell a pretty strong story, but still it's falling right now. Closer to 5% almost.
Well, Anjali, another stock that I know you're taking a look at is shares of Novartis. There was an outlook boost, but it was kind of expected from the street. Was it just not enough?
Yeah, so their story is also based on one specific product that everyone is looking at, Entresto. That's a heart failure drug. Sales of those have been very strong, 1.8 billion. But in addition to the fact that they're losing the patent next year, that's been sort of dragged out for some time. A judge ruled against them initially for extending that patent, but they have managed to bring it out to the middle of next year. So that's when that top blockbuster for them goes off. And they do have stuff in the pipeline to replace that. So that's really the focus of the company, is how it's going to take a very robust pipeline and actually translate that into market moving and blockbuster type drugs to replace the loss of one of their biggest products, which is that heart failure drug.
All right, Anjali, thank you so much for joining us. We really appreciate it, as always, here. We're going to take a look at shares of DR Horton because they are moving higher. They're actually up over 8% despite quarterly orders missing expectations, as consumers still grapple with the weight of those higher mortgage rates. At the end of June, the home builder had 42,600 homes in inventory, with just over 26,000 left unsold here. But one thing that I'm seeing in some of the analyst reaction here is that there was a 1% increase in net new orders. That did fall far short of analyst expectations. That recent pullback in mortgage rates falling below that 7% handle that we saw through April and May could make analysts see that result as sort of backward looking, because we are getting that drop off in mortgage rates. So that could be why we're seeing a little bit of a lift here. Also, the commentary around demand is going to be really important for this stock, given that some of that mortgage rate changing is potentially making the earnings print a little bit backward looking. Gross margins, though, coming in much stronger than anticipated. They also had an outlook for the fourth quarter of the year that came in above expectations, and I bet that focus on the call coming up is going to be another critical catalyst for the stock.
Yeah, I think a lot of this just centers around what exactly the Fed is going to do, how that's going to impact mortgage rates here down the line. We know so many buyers have been sidelined, given the fact that higher home prices coupled with higher rates, right around 7%, has kept them from buying homes. They no longer can afford them. And then also adding to that has been the existing home market, where so many people have been locked into their homes because of the fact that they have much lower rates than what is currently being offered right now, just in terms of the 30-year rate. So obviously that's adding some hiccups here and some challenges here to the broader housing market. Because of that, that has been giving just a bit of a lift here to the new home sale market, because they're almost the only game in town when it comes to those homes that are available to be purchased at this time. But again, when you take into account the fact that we are up against higher prices, the fact that mortgage rates, yes, they have improved a bit, so will be more interesting to see what some of that current commentary, the commentary is about the current quarter here, and whether or not they're starting to see any pickup in demand. When it comes to their outlook, what they are expecting for the remainder of the year, they have their sales volume here is now expected to deliver between 90,000 and 90,500 homes, slightly higher than what they had given their prior forecast here. They narrowed their forecast just a bit, but again, lots of questions about what ultimately the timing of that catalyst for the housing market and what it's going to take to really unlock the supply of homes going forward and therefore demand. So we'll see.
Absolutely. Big Fed watch day for a lot of stocks here. But coming up, we're taking a look at another stock because shares of Domino's down around 12% after falling short of analyst expectations on their earnings. We're going to have analysts reacting to that on the other side of this break. Shares of Domino's sliding down now over 8%. They were down over 12%, which was the most they'd been down since 2012. Now, this comes after they missed second quarter revenue estimates and indicated fewer store openings to come. So for more on the company's results, we are joined by Danilo Gargiulo, AB Bernstein Senior Analyst. Danilo, thanks so much for being here. So talk to me about what stood out to you from the Domino's earnings print, given that we are in an environment where some consumers are struggling, and you would think that that would potentially be a catalyst for a name like Domino's.
Yeah, I would say it was a tale of two cities. On the one hand, the demand in the United States as well as in international was very encouraging. I mean, you look at what the same-store sales were looking in the United States. Clearly, they were boosted by a combination of the value that you were discussing, but also the underlying strength of the loyalty program that was launched in the fourth quarter of last year, coupled with increased access to consumers through the partnership with Uber Eats and eventually with new aggregators coming in. So the top line, so the same-store sales were quite positively impacted this quarter. On the other hand, international markets, where the unit growth in international markets, as you pointed, are slowing down. There are some challenges with one of their master franchisees operating in Japan, operating in France, operating in Australia, so DPE, which resulted into management reducing their guidance on the unit growth in 2024.
Danilo, when you take a look at the fact that they did suspend their long-term guidance, I'm curious what you think this suggests going forward and how long some of this weakness, or I guess how big of an overhang you expect this to be on the stock.
Yeah, I think it might be an overhang on the stock until there is more clarity on the future potential for Domino's. I mean, Domino's historically has had in their international market their growth engine. So clearly fixing the United States was very relevant for Domino's in 2023, but all eyes and ears are going to be increasingly more into the international markets. And so not having clarity on what the future potential might look like in terms of unit expansion might spook some investors. I think that the fact that they suspended guidance in international markets is indicative of management wanting to have the maximum amount of transparency with the market and making sure that before they put out another guidance, they feel more safe about the real opportunity that is outstanding.
I want to talk a little bit about Darden. So switching gears just a little bit, because we have news about Darden, and I know this is one of the names that you cover. Darden agreeing to buy Chewy's, the Tex-Mex chain, for those that aren't familiar. Darden moving to the downside on that news. Chewy's shares absolutely skyrocketing up more than 49% here. Why does this deal make sense for Darden?
Yeah, I think this deal makes sense because growing in the full service restaurant category, especially in the casual dining category, which is a variety seeking category, despite the scale, you might be structurally constrained in your ability to grow with your existing brands. And clearly Darden has a pathway toward this growth, but adding something onto their portfolio of brands, which is a little bit faster growing versus their Longhorn and versus their Olive Garden, will be boosting the long-term algorithm for Darden, and so enable them to actually reach higher scale going forward, which will result into potentially better synergies and better access to their consumers.
Danilo, I'm curious your take on the consumer right now, because we're starting to see mixed reports. Domino's included is pointing to some weakness maybe that we are seeing in terms of consumers pulling back. How much of that do you think is going to be a theme this quarter? And given that, who is then, do you think, best positioned for the quarters to come?
Yeah, I think you're spot on. I think it's going to be the hottest theme of the second quarter. I think the deceleration that we are starting to see in June is puzzling investors, right? People are trying to understand whether the guidance that many of the companies have provided, which is a kind of a hockey stick recovery in the second half of the year, whether that one is going to be still on the table, given that the demand is slowing down in June. And so extrapolating only in 1 month is obviously extremely hard, but all eyes and ears are going to be on whether the consumer ability to spend is decreasing more recently. I think, from what we've been hearing from various companies, the challenge remains on the low end of the consumer spectrum. So the mid and high income consumers are not as affected by this slowdown in demand. But obviously, the companies that are more operating into the quick service restaurant space, so the likes of McDonald's, Burger King, Wendy's, are going to be a little bit more under the radar, under scrutiny in the second quarter.
Danilo, I want to end with one other consumer name that is under your coverage here, and that's Starbucks. Starbucks in particular struggling last quarter with their earnings and the high prices, frankly, on a lot of their products. You've got a market perform on this stock. Have they done what you wanted to see them do to change your market rating potentially if they are able to deliver this cycle?
I think management is working toward a set of demand-driving initiatives that could be helping in the short term. I think to really realign the value positioning of Starbucks toward what consumers might be looking for, it might take some time. We're talking about some realignment of pricing versus the expectations and the willingness of consumer potentially to pay. We're talking about maybe the store experience improving, given that the Starbucks of today is a much more complex store compared to the Starbucks that we used to see in pre-COVID levels, right? In pre-COVID, a Starbucks that was more kind of single channel versus now you have many more ways of accessing to your coffee. space. So the complexity of the store operations might be impacting also the willingness of consumers to go to Starbucks. And it might take a little bit of time for Starbucks to access again to some of the lapsing consumers, especially the kind of less frequent consumers within their base.
All right, Danilo, we're going to have to leave it there. Thank you so much for joining us. That was Danilo Gargiulo, AB Bernstein's senior analyst. Coming up here, Morgan Stanley feeling bullish on some retail names. We'll discuss why the firm is calling Gap a top pick on the other side of this break.
Morgan Stanley feeling bullish on Gap. Shares getting a boost after the firm upgraded the retailer to overweight from equal weight. The argument here, they're saying that the stock offers, quote, among the greatest fundamental recapture opportunities. That's pretty strong words. Looking at a price target here of $29, that was actually unchanged. When you dig into this report here and why they see upside here for the stocks, are saying incremental confidence in the new management strategy here going forward. This comes after the Q1 results. Also, they had some internal meetings there most recently in June. That's making them a little bit more optimistic about what the road ahead looks like for Gap. They see potential for positive EPS revisions, earnings per share revisions in fiscal year 2024 and beyond. And Maddie, Gap is one of these names where Wall Street remains split on what exactly that turnaround looks like, how long it's going to take to really get underway. They are seeing some signs of improvement, but even you can tell just by the stock's reaction or I guess the pattern that we've seen over the last several months, a lot of highs and a lot of lows. We can see there's many that are not convinced that some of the peaks and some of the strengths, some of the positives that we have seen in past reports whether or not that's going to stick here going forward, given the fact that it's an increasingly more competitive environment.
Yeah, it's interesting too, taking a look at the broader names within this note and how that might apply to the outlook for Gap specifically. This analyst noting that the scorecard that they developed for a lot of these names might be kind of more moving to the bias side for upside on some of the department store style retailers versus the off-price retailers like a TJ Maxx, for example, which is mentioned in this note. However, I do want to focus in on Foot Locker, and it's interesting to me to take a look at why exactly Morgan Stanley talks specifically about some of the downside pressures on Foot Locker, moving to the bearish side on this stock because of weaker performance from Nike specifically, noting that Foot Locker previously talked about a return to growth at Nike specifically as a driver for potential improvement moving forward. What we know about Nike so far is that it's not necessarily a stock to bank potential upsides on for other companies that are interacting with it. Nike continuously having quarter after quarter of downside pressure. That is why Morgan Stanley cut their price target for Foot Locker from $24 a share down to $18 a share. So I think that's not only putting some pressure on Foot Locker today, but it's also an indicator of some of the movement that we might continue to see from Nike as well.
Certainly, that's smart to point out there. All right, we'll keep right here on Yahoo Finance. We've got much more coming up. Our Fed correspondent sitting down with Chicago Fed President Austin Goolsbee to discuss the path forward for rate cuts. That's next on Catalyst. We'll be right back. It's just after 10 a.m. here in New York City. I'm Shauna Smith alongside Madison Mills, and let's dive into the catalyst moving markets today.
Expectations for the Fed to cut rates in September nearing 100%. We'll hear from Chicago Fed President Austin Goolsbee on the path forward in just a moment here.
And we're seeing a rebound in tech stocks here this morning, driven by better than expected results from Taiwan Semiconductor. You've also got Nvidia trading to the upside on the heels of that news. Investors now looking to Netflix earnings after the bell for another sign of strength here within the sector.
And the U.S. presidential election will, of course, have ripple effects across the globe. According to Goldman Sachs, the Trump presidency could be shocking to European allies. We'll talk to one of the strategists behind that call later in this hour. But first, we have to talk about the anticipation around Fed rate cuts. Investors now pricing in almost a 100% chance that the FOMC will lower rates by September. So what do committee members need to see next to become more confident in that call? Yahoo Finance Fed correspondent Jennifer Schomburger has more. Jennifer.
Thanks, guys. For more on what the Fed's next moves could be, I want to welcome into the program Chicago Fed President Austin Goolsbee. Austin, it is great to see you as always. Thank you so much for joining me.
Yeah, thanks for having me back.
We have had 3 consecutive months of good readings on inflation data as measured by the Consumer Price Index, following 3 months of poor readings in the first quarter. At the same time, looking at the Fed's preferred inflation gauge, the Personal Consumption Expenditures Index, that's also showing improvement and expected to show continued improvement for the month of June. So how confident are you right now that inflation is returning to your 2% target?
Well, it makes me feel a lot better that we've had multiple months in a row of improvement, and that this bump in the road at the beginning of this year looks like a bump, which followed, importantly, 7 straight months of very strong inflation numbers at the end of last year. So if you just kind of look at the through line, it's very clear that inflation's come way down in a 12 to 18 month period. This is about as fast as inflation has ever fallen in the U.S., and we did it without a recession. That's what I call the golden path. It's not done, but it makes me feel a lot better when you both see it for multiple months in a row, and you see the components that you're finally starting to see the declines of housing inflation that we've been anticipating, and you're seeing improvement on the services side too.
Assuming we do get progress on the June reading for the Personal Consumption Expenditures Index, which is due out next Friday, would that give you the confidence that you need that inflation is sustainably coming back to 2%, or would you need more than a quarter's worth of good data?
That's a little bit hypothetical. We get a lot of information. There's not just one thing that we look at to try to gauge, or that I look at. I'm not to speak for anyone else on the committee. Those are the rules. So I think the more information we get that shows that the economy does not look like it's overheating, and that we're getting improvement both month after month and in the components on inflation, like what we've now seen for several months in a row, to me, that's what the path to 2% looks like, definitely.
The unemployment rate has ticked up for 2 consecutive months. We now stand at 4.1%, which is low by historical standards, but that's up from 3.4% over the past year. So what signal are you taking from the bump up in the unemployment rate now above 4%? How are you viewing that?
Yeah, I like your characterization that the level is pretty strong, pretty close to what economists consider full employment, what the median SEP dot says is long-term unemployment, and yet directionally, the labor market has been cooling. It's been cooling to a position of better balance, but it has been cooling. And that in itself is not the usual historic norm. It doesn't usually cool mildly. We are either improving or getting worse. So it's definitely an area of concern, one to keep your eye on. There are some other warning lights, I'd say, but so far this doesn't look like a recession. It's just a cooling back to better balance, but it needs to stabilize at that and not keep getting worse.
You just said it's a warning light. Are we approaching an inflection point in the labor market where perhaps if we see further softening in demand for workers, that could result in a bigger and less welcome increase in unemployment?
I hesitate only of what it depends what you mean by inflection point. If we're getting to a steady state position of balance, which is what we want to, then this slow cooling of the labor market to something like the full employment rate, it should stop there. And we want to be stable at a kind of a steady state basis. So for sure, if unemployment continued to deteriorate, or if you saw a sharp uptick in unemployment looking like what happens at the beginning of a normal recession, you would be definitely justified to be agitated about the employment side of the mandate. Thus far, it doesn't look like that. I mean, the levels are still historically, as you pointed out, pretty low, pretty close to what we think of as steady state, but it needs to steady. It can't keep going like that.
So how are you factoring your outlook for the labor market into the path for monetary policy when you're looking to set interest rates?
Well, I think the first thing is the bump up in inflation, especially January, February timeframe of this year. It was important to take stock. Is that a sign of overheating? And one of the first places you want to look for signs of overheating are broadly defined the job market. I have been saying that the job market didn't really look like traditional overheating. Most of our measures, not just the unemployment rate, but if you take the quit rate, the unemployment to vacancy ratio and things, the various ways that we measure the labor market, most of those were still cooling and going back to better balance. So I think the job market as an indicator of where we are in the business cycle is one of the important ways. And then the second is, it's right in the law. That's the Fed's mandate, maximize employment and stabilize prices. So we're supposed to be, and we do, look at employment on its own because the law requires us to.
Right. So given the cooling that you're seeing in the labor market, coupled with the fact that inflation is coming down, you're saying that perhaps what we saw in the first quarter was a bump in the road. Do we have the basis right now for a rate cut?
Well, I don't like tying our hands ahead of time when we're going to get a bunch of data before the next meeting, and I like to hear what the views are of the other participants of the FOMC. So I'm not going to say this number says we should do X at the next meeting, but I will say the through line. Yeah, this is what the path to 2% looks like, and you saw in the FOMC statement, voted on by all of us, that we have said the committee would not consider rate cuts until we had more confidence that we were on path back to 2% inflation. And to me,
be clear, you are on the
months
path
like
right
the
now.
ones we've been seeing, that's the path.
So you are on the
say
path
again?
right now, is that right?
I like that path, but as I say, I'm not tying our hands. We're going to get a lot of information before the next couple of meetings.
So then is the case building for a potential rate cut in September, if not in the next couple of weeks at the end of this month?
Well, like I say, I'm not going to say about the timing. The more months you get, like last month, the month before, and even the month before that, the more months of data you get, like the last 7 months of last year, for sure, that's what the path to 2% looks like. And that's the golden path, as I called it, that inflation has come down very rapidly in historic terms without a recession. And that's never really happened before in the U.S. or in almost any of the advanced economies. So let's stick with the program. So far, that's working pretty well on the dual mandate grounds.
To your point, last week you said that when inflation was over 4%, that's when you hiked rates to current levels. Now you said let's call it around 2.5%, implying that we have tightened. So do you risk the golden path if you don't cut soon?
Yes.
So then what does that set us up
You risk the golden. If you're going to be as restrictive as we are now, and if I just look at the real Fed funds rate, the interest rate minus inflation, that's as high as it's been in decades. And when do you want to be that restrictive? As I say, you want to be restrictive if you're afraid of an overheating economy. The economy's not overheating, and we set this rate, as you point out, when inflation was over 4. So in real Fed funds terms, we have tightened pretty substantially. And let's just make decisions about restrictiveness by choice. Let's not back our way into it. That's my view.
So then where are we in this economic cycle? Are we late in this expansion at this point? And do you need to be ahead of the curve, right? When we look at the labor market, we know that peaks after the economy peaks. Do you need to be ahead of that?
Yeah, the question mark is, does this cycle look anything like or how much like previous cycles? So far, there are so many things different about it that it's a little hard to generalize lessons from past business cycles for what we should do right now, or even to figure out, are we in a late inning, a middle inning, an early inning on the cycle? We had a recession that was driven by a collapse of services, which never happens, where durable goods and a bunch of the things that are usually cyclical actually went up during COVID because people couldn't spend their money on other things. We've seen a gradual increase in the unemployment rate. That never happens in a business cycle. It usually goes up like a rocket and down like a feather. And we've seen a major increase in rates, 550 basis points or so, without what you would have expected to be the severe negative consequences on the most interest rate sensitive sectors of the economy. So I think given how unusual the last 4 or 5 years have been, we should be a little circumspect with concluding what the lessons of past business cycles are.
Austin, in order to stay on the golden path this year, ballpark, how many rate cuts do you think are needed?
I don't know. The issue that I will point out, I don't like tying our hands or committing to rate cuts at the next meeting. I definitely
But
do
how
not
many? I'm
like
saying how many, not
deciding
necessarily
things
when.
for 4, 5, 6 meetings from now.
But what about the number, right? Not just when you would do it, but like how many you think? Like 1,
that's what
2.
it is. If you give a number, you are saying what you think should happen over the next 6 or 8 meetings, and I decline to do that. I think the way the FOMC works and is structured, we decide meeting by meeting what to do. I don't think that we need to be committing to a path of what we don't know what the conditions are going to be like 6 months from now, so I'm not comfortable committing to numbers of cuts, holds, or increases for multiple meetings in the future.
All right, well, I tried. Austin, thank you so much, as always, for your insight. Really enjoyed the conversation. Look forward to talking to you soon.
It's great. It's always fun talking to you.
Thanks so much. That's Chicago Fed President Austin Goolsbee. Shauna, I'll send it back to you in New York.
All right, Jen, thanks so much for bringing us that great interview. That's Jennifer Schomburger, along with Chicago Fed President Austin Goolsbee. Let's continue the conversation surrounding the Fed's rate cut, a path forward. And we just spoke to Chicago Fed President Austin Goolsbee, saying that inflation is on the path to the Fed's 2% target, but won't, quote, tie the committee's hands to a policy decision before getting more data. Investors, however, are getting more and more convinced of a September rate cut, with odds near 100% on the CME Fed Watch tool that we will see a cut in September. Joining us now is Stephanie Roth, Wolfe Research Chief Economist. Stephanie, it's great to talk to you. So let's start with some of the commentary that we just got from from Chicago Fed President Austin Goolsbee, and I want to start with his comments on the labor market, because I think that's coming more and more into focus. Yes, we have made some progress on inflation, but we are starting to see some weakness in the labor market here, and the latest just being the jobless claims report that we got out this morning. I'm curious if you agree with him just in terms of the fact that it is raising some red flags, not too much to be concerned about yet for now, and it still seems like we're nowhere near a recession.
Yeah, and I think that's totally fair. He talked about early warning signs, and the Fed is clearly starting to get a little bit more concerned about some of the labor market data that we've seen. So far, they're calling it a sweet spot, but they just don't want to see things deteriorate further from here. So it's prudent to start talking about rate cuts, and kind of in our view, the most likely rate cut is going to be in September, and the chorus of Fed speakers have been alluding to that. I do want to flag on the unemployment claims data today. Some of the jump appears to be driven by the hurricane in Texas, so it is probably exacerbating some of the trend that we've seen. But if you take a step back, we're starting to see the labor market conditions soften at least a little bit. We're now looking back towards where we were in 2019. Beverage curve is back towards where it was the last time, so kind of back to sort of normal types of the relationship there. Quits rate is back down even below where we were at its peak in the last cycle. So we're really starting to see a normalized labor market. The Fed just doesn't want things to deteriorate further from here, which makes perfect sense.
It's interesting, Stephanie. What stood out to me at least is when he said, well, I feel a lot better. So I'm happy for him that he is feeling a little bit better about the path to 2% here. But he would not, of course, commit to any definitive answer on the path to lower interest rates. What did you take away from the subtext of what he was saying without saying? Did you get an indication?
I think in addition to what Austin Goolsbee said, and if you take a step back and look at the Fed speakers over the past week and a half or so since the last CPI print, the message has been very consistent among Fed speakers. It's been a message where inflation is coming back down closer towards their target. They're on the golden path, which is exactly how he described it. And the last 2 to 3 prints have been kind of consistent with that. They're emphasizing perhaps even a little bit more the employment side of the mandate versus the labor versus the inflation side of the mandate. So they're starting to get a little bit more concerned on that front. And the rise in the unemployment rate and some of the other labor market indicators are starting to get their attention. So, my sense from hearing the Fed speakers is they're certainly gearing up for a September cut. It seems, and the markets are fully priced for that. And they don't really want to give much indication beyond that. Our base case is that they'll be cutting in September and December, recognizing the market has gotten even ahead of that further and is looking for a November cut. Our base case is the economy won't necessarily be soft enough to warrant that. But the message from him, along with the bulk of the speakers that we've heard over the past 10 days or so, is really just that they're getting ready for a September cut. And the first step of doing a cut is to talk about cutting. So we're making progress on that front, and they're kind of gearing up for that cut. Kind of a little bit early, considering they still have a July meeting ahead of us. Perhaps they just want to ease financial conditions a little bit to help stabilize some of the parts of the economy that they're getting a little concerned about.
Stephanie, what's your base case at this point for rate cuts?
In terms of cuts?
Yeah.
Base cases, we're looking for September cut, December cut. And then we're looking for a quarterly cutting cycle from there, bringing rates back down to about 3.25 to 3.5%. So we think it'll be a very gradual easing cycle, which is a bit unique. But generally speaking, the Fed isn't doing a prolonged easing cycle in a period that's non-recessionary. So as Austin Goolsbee also mentioned, this is a very unique cycle, and this might be just one additional unusual aspect of it, that it's going to be a very slow path towards getting to the trough Fed funds rate, and one that's a little bit less bumpy and less painful than is often the case.
All right, Stephanie, loved getting your insight, your reaction to what we just heard from Austin Goolsbee. Thanks so much for making the time to hop on with us here this morning. Keep it right here on Yahoo Finance. We've got much more of your market action ahead. Stay tuned. You're watching Catalyst.
Let's get to some trending tickers here. Ford is expanding production of its large Super Duty trucks to a Canadian plant that was originally meant to be converted to an all-electric vehicle hub. So is this a sign that Ford may be shifting away from EVs more broadly? Let's bring in our senior autos reporter, Praz Subramanian, to discuss. Praz, that's my very first question for you. Is this a signal of things to come?
Well, it's definitely a big, a course correction there, right? They were going to earmark that plant in Canada to make their large three-row EV SUVs there, right? And then they got pushed back to 2027, and now this plant is now being used to expand production of the Super Duty trucks, the big commercial application type trucks that are used by governments and big construction companies, et cetera. So that plant, they're going to spend around $2.3 billion to retrofit that plant. Going to start making those trucks in 2026, about 100,000 a year. So that's big production numbers there. As for EVs, Ford said it was still committed to making the three-row SUV. They didn't say where it's going to be built, but probably presumably at that same plant, delayed till 2027, as I mentioned. But yeah, it seems like they're going to focus more on those really kind of high profit, big trucks that they need. And they said they weren't meeting demand at this moment.
All right, a story that we're going to continue to follow. Praz, great stuff. Thanks so much. Well, ELF shares on the rise after Baird upgraded the stock to outperform, raised their price target to $230 a share. The analyst behind that call citing several reasons for the move, including, quote, healthy brand momentum. And Maddie, one of the things that stuck out to me in this report where they were talking about China tariffs. And I think that this is central to so many companies as they're talking about potential headwinds or challenges given who is in the White House, although both very hawkish on China given their recent rhetoric and recent decisions that have been made during the administrations. But the analyst here making the argument that incremental China tariffs in a potential Trump presidential win is a, quote, manageable risk, he thinks, going forward, given the brand's, quote, demonstrated pricing power and still attractive price positioning versus the peers. So again, kind of discounting or again thinking that maybe some of the challenges that they could incur, given if we were to see a ramp up in tariffs here, if Trump were to be elected in November, that it's not something that's going to fundamentally change the investment story surrounding ELF.
Yeah, we saw JP Morgan adding to that, two analysts over there saying that the pressure on ELF shares a little bit overdone, and especially if the reasoning behind that pressure from investors is driven by the so-called Trump-China tariff trade. And this is because ELF is kind of one of the go-to names for consumer trade down, right? I'm still blown away, frankly, by the degree of affordability for a lot of ELF products. And that's why one of the reasons why I was so excited to talk about this stock today, because it was down over 9% in the close yesterday when it's up 45% year to date. I want to pull up the 1-month chart for this name, though, really quickly, just to take a look at the degree of the downside pressure that ELF has seen over the past couple of days here. Even over the past 5 days, it's down over 16%, just indicative of the degree to which some of those geopolitical question marks with the market continuing to sort of price in a Trump presidency come November here is really starting to weigh on some of these consumer names like an ELF that would potentially have some downward pressure off of those proposed Chinese tariffs. But according to these analysts today, it's time to buy this stock instead of getting afraid of some of that pressure that we're seeing. Taking another look at a company we're watching, Beyond shares sinking this morning after the Wall Street Journal reported that the company engaged with a group of bondholders to initiate discussions about a balance sheet restructuring. The stock has had a rough time since it went public back in 2019. Shares are down about 90% from that IPO. And if you take a look at shares for Beyond today, they are down, I believe, over 9% here, sinking again after this plant-based meat maker talking about restructuring here. It's down nearly 9% an hour after the market open here. And again, this is a name that continues to struggle in a very competitive market and also struggling. I mean, we've seen so many idiosyncratic news events impacting this name. I think back to the Nathan's hot dog eating conversation leading to some movement on this stock, but certainly not enough when it comes to some of the company fundamentals that we're seeing, Shama.
Yeah, and our executive editor, Brian Sazzi, reaching out on the heels of this report last night and able to confirm with a source about the bondholder reach out there going forward. But again, I think this just brings up lots of questions about what the future looks like for Beyond Meat. This is a stock, if you take a look at the max chart here on the stock, it's down tremendously, just around 90%, I believe, right around 90% on that max chart here. Lots of questions about what exactly demand is going to look like going forward, ability to offset rising costs, and exactly what the future holds. And you can see really really over the last year or so. We haven't seen too much movement just in terms of the fact that how far it had fallen from those peak levels that we had seen a couple of years ago. And again, over the past year, you're still looking at losses of another 60% here. And again, trending right along at the bottom of that chart here over the last several months. So here we are today with that stock trading below $7 a share. So again, we will follow this story going forward. Well, Meta reportedly in talks to purchase a stake of about 5% in the maker of Ray-Ban sunglasses. This is according to a report out from the Financial Times. The stake would be valued at just under $5 billion. When you take a look at what exactly the FT is reporting within this, now one of the reasons why they would be interested in this is because Facebook has obviously been pushing into eyeglass, where they had a partnership that had been existing here and reportedly has been holding talks to deepen that existing collaboration following the successful launch that we have seen of the Ray-Ban Meta smart glasses last year. So maybe a further push into this, I could say no more eyewear down the line. But again, just reports here from the FT about this.
Yeah, it's interesting because a lot of analysts coming out saying that they believe augmented reality is not going to be as big of a driver as VR for Meta. In terms of units shipped, it's looking like about 10 to 15 times smaller than VR in terms of that. But it could grow at a faster rate, particularly given that smart glasses are primed to have an infusion of AI technology. And that is exactly what we are potentially going to be seeing from Meta. I know from some of the reporting I've been doing with our video team here that Meta has been investing heavily with neuroscientists who've been working on ways to incorporate AI and some, cognitive technology that helps AI technology have a view into what users may be thinking about and what they may want to be clicking into. You can see our much broader investigative piece on that on our Yahoo Finance platform. But I'm bringing that up because this is not a surprise. We know that Meta has been investing in neurotech, smart tech like AI, and of course incorporating Meta AI, its AI assistant, into several forms of technology, the latest being these smart glasses. And Meta, to your point, has been working with Ray-Ban and this partnership with EssilorLuxottica since 2021. So definitely getting this teased out a little bit from Meta here. Well, coming up as Q2 earnings start to kick into full gear, we're going to have a preview of what analysts are expecting to see over the upcoming weeks, so stay tuned for more.
Second quarter earnings season kicking into high gear. Many of the big banks already reporting earlier this week and last week. We've also got Netflix after the bell today. Expectations are high. Wall Street has set a high bar for this earnings season. Now they are estimated to grow, or after EPS, after earnings grew an estimated 8.8% growth, was the largest increase that we saw in just about 2 years, expected to grow 8.2% in the most recent quarter here. So for more, we want to bring in Michael Reinking. He's a New York Stock Exchange senior market strategist. Michael, it's great to have you. So again, it looks like Wall Street really setting that high bar when it comes to earnings season. I'm curious how big of a driver you see earnings season really being, if it's going to be enough here to keep this momentum to the upside.
Yeah, so I mean, I think it's pretty interesting, and as you pointed out, right, according to FactSet, we're looking at earnings growth on a year-over-year basis up about 9% for this quarter. That's the biggest growth since Q1 of 2022. But I think very much like the markets, the expectations within those earnings estimates are kind of bifurcated, right? So we've seen this strength at the top end, in terms of the mega cap tech stocks. I think, the expectations for those stocks are, very, very high. So the bar is set very high at this point. And then if you look at other areas of the market, right, that haven't performed as well, at least until the last week or so, I think the bar had been, kind of sort of lowered. But, just given that markets are so dynamic, my thinking, around a lot of that has actually shifted, even just over the last week, just given the rotation that we've seen.
That's exactly where I wanted to go, was this rotation. Is this earnings cycle going to further that rotation, or are we just going to see a day like today where you got great earnings from TSMC and then the tech trade is right back on?
Right. So, in terms of, kind of the rotation, right, I think what you're going to see here from like the institutional investors, right, is that given we've had this very big move higher, right, I think when you do see some earnings weakness, right, they're going to come in to use that opportunity, right, to kind of buy a little bit of stock as companies move lower, right? If you look at sort of kind of positioning, in and around options markets and the dispersion that we've seen within markets, right, you've seen kind of index level volatility remain very low, but that single stock volatility has been really high, right? So I'd expected to see, these outsized moves on a single stock basis, but I wonder at this point if you have earnings misses that, aren't accompanied by, really negative revisions to kind of the forward guidance, right? If you just see some of that downside buffer, just as people are trying to buy stock a little bit cheaper.
How do you think investors should be thinking about this rotation, just in terms of how they're identifying those opportunities, when they're identifying those opportunities? And we talk about how much you shouldn't really just focus on timing of the market, but I think so many people are very caught up with the catalyst that we do have potentially with earnings, the Fed rate cuts, election. And I think it has people a little bit confused about when to jump in versus staying on the sidelines.
Yeah, so this was actually something that we had talked about in our mid-year update, right? And we were looking at the idea of this rotation, right? In and kind of performance of small caps, relative to large cap stocks as you move closer to the rate, to the beginning of the rate cutting cycle. So if you look back historically, right, we're kind of in that sweet spot where you do see, during the hiking cycle, you typically see the large cap stocks, outperform, and that makes sense, right? Given their balance sheets are, generally better positioned, and the smaller cap companies, have more interest rate sensitivity, and then as you kind of get into that kind of 3-month time frame ahead of the first rate cut in a cycle, you do start to see those small caps start to kind of outperform, and that can continue into that kind of 3 to 6 months after the first cut cycle. Where that kind of breaks is if you do see that cutting cycle coming if you start to see kind of a credit event, and that's where that will break down in terms of the small caps will start to underperform again.
I want to end with an AI question for investors listening who want some advice about how to listen in on these earnings calls. Is this going to be the quarter where companies can really prove out their AI investments and say, oh, this is actually saving us money in this area, or is it still just going to be a little fluff?
Yeah, no, I don't think we're there quite yet. I mean, I think that in some cases, right, we are seeing kind of the use case, very much being, kind of put in place, companies like Meta, right? I mean, they're already, kind of very much integrating AI into their business models. But I don't think broadly you're going to necessarily start to see that. We are starting to hear more about companies using it for kind of supply chain, logistics to help, kind of, make those processes more efficient. But I don't think, we're at that point of the cycle where we're going to really see kind of the end, companies, really being able to, show that the AI is really helping the bottom line.
All right, Michael, thank you so much, as always. Thanks for coming in studio with us. It's good to see you outside the floor. We appreciate it.
Thanks for having me.
Michael Rankin, NYSE Senior Market Strategist. Stick with us for more of your markets action ahead. You're watching Catalysts. The European Central Bank decided to hold rates steady in June, citing little change in recent data. Now investors are looking to September for the central bank to potentially cut rates once again. When asked about the September meeting, this is what Christine Lagarde, president of the ECB, had to say. Take a listen.
We were determined to be data dependent, to decide meeting by meeting, and not to have any predetermined rate path. So the question of September and what we do in September is wide open.
Joining us now, we have Sharon Bell, Goldman Sachs Senior Equity Strategist. We're also joined by Karsten Bresky, ING's Global Head of Macro Research. Thank you both for being here with us. Karsten, I want to start with you because this was very different than what we heard last time with the June rate cut from the ECB. What do you think was the single biggest driver of that difference?
Well, there were two drivers, to be honest. One is the economic momentum is fading already again in the Eurozone. And the other one is that inflation is still stickier than the ECB thought in June. And this combination has made the ECB more reluctant, more cautious to give any forward guidance. And I think there is now only maximum a 50% chance that we will actually get a second rate cut in September.
Sure. When you come to what we are hearing here from Lagarde and exactly what this means going forward, I think one of the big issues right now is the real wages in the Euro area have been growing now for almost a year. That coupled with other signs of inflationary pressures, how do you see that influencing the ECB's further or rate cut decisions potentially here down the line and what the timing of that could look like?
Yeah, so I think there are bits of inflation that have come down a lot. Energy price related inflation in particular has come down a lot. Goods price inflation has come down a lot. But services are quite sticky. And that is somewhat related to quite high wage growth still and quite low unemployment. So, I mean, in a way, that's great because that's good for the economy. But it does mean that there's parts of inflation that are still relatively sticky. Now, we do think that Lagarde, the ECB, will be on a sort of quarterly cutting path from here. But I think that some of that caution reflects the fact that there's bits of bits of inflation which are still sticky and high.
Kirsten, my question to you is, if we do see the Fed here in the U.S. delay any sort of rate cut, does that complicate matters from a global perspective, from the global central banks, just in terms of what that path forward would look like?
Oh, definitely it does, because this is already the first. That's the first cycle already that we see actually the Fed starting before the Fed. If the Fed was really to delay the first rate cut, it means also for the ECB that there are good reasons for that. And that good reasons will be stickier inflation in the US. And if sticky inflation is a global theme, it means that the ECB might have gone too early with the June cut and that they will have to wait at least until December with the second rate cut.
ECB President Christine Lagarde was also asked about the impact that increased tariffs could have on economies in Europe. And this is, of course, referring to increased tariffs that could come if Trump ends up in the White House again come November. Here's what she had to say.
The issue of tariffs that you mentioned, that's an important aspect, an increase in trade, as a result of which export out of Europe to the rest of the world would matter. And this is an area where we will be attentive, of course, to whatever political decisions are made by whoever in the future.
Keyword being by whoever in the future. And it's interesting, Sharon, I want to go to you on this because we're sort of hearing a little bit about policy that could come from both Biden and Trump that would lead to potentially some overcapacity in China if the U.S. does institute any protectionist policies, really. Talk to me about the extent to which that could potentially hinder growth in Europe and how that could impact the ECB moving forward.
Yeah, look, I think Europe is essentially a large open economy. It's a trading economy, and especially Germany. And we do think that if Trump, for example, came in, if there was a blanket 10% tariff on imports going into the US, that would impact Europe quite severely by a number of routes. I think probably the biggest one is just global trade itself would weaken a lot. There will be a lot of uncertainty around it. You might also get more dumping into Europe from China. As you say, if China's not looking to export so much to the US, they may be looking to do so for Europe. I mean, on the one hand, of course, that could be a little bit disinflationary for Europe. But on the other, I think generally with Europe being a big exporter, very dependent on global trade, it would hit GDP. We reckon that 10%, if a tariff, it was globally applied, would take about 1% of euro area GDP, so very significant.
Sharon, are you at all adjusting your recommendations yet, or is this very much still a wait and see given the timing of this and where we are?
I think it is a wait and see still. We don't know the outcome of the election, obviously. And even if we did, we wouldn't know who and exactly what policy will be implemented. But yes, we have taken a little bit of our sort of sector recommendations. We've shifted them a little bit more what we would call defensive rather than too cyclical. And that is also partly because there's been a bit of a weaker, softer spot for data globally as well. So not just related to the election. But of course, there are those election risks. There is a risk around tariffs. And, you know, tariffs aren't just being applied or potentially applied by Trump. Biden, too. You've got the EU as well putting tariffs on some particular goods coming into Europe. That sort of global trade uncertainty is unhelpful.
Kirsten, I'm curious how you're looking at the protectionist strategies that we have seen and the potential for tariffs, what that fallout looks like for Europe and beyond.
Well, it's clearly weakening European growth perspectives, and it is also partly pushing more inflationary pressure for Europe. So this again makes Europe probably the weakest spot in the global economy. We're also seeing that Europe is kind of choosing then to have its own protectionism, that we will see more industrial policy coming to Europe, which means that we will see at least governments trying to support and to subsidize certain sectors in Europe in order to at least keep some domestic growth momentum going in Europe. But for now, given that Europe is so depending on global trade, on China, on the US, it means that if we were to see more trade tensions coming, whether it's tariffs, whether it's other impediments, we will see that Europe is probably the place that suffers the most.
All right. Thank you both so much for joining us, Karsten and Sharon. We appreciate you taking the time. Coming up, energy policy has been a major talking point at this week's Republican National Convention, the RNC. Former Democratic presidential candidate General Wesley Clark is here to give his reaction on the other side. We'll be right back. Former President Trump set to give his primetime address tonight at the RNC, and many in the energy sector will be paying close attention to any potential comments he makes about oil, alternative energy, and electric vehicles. So how will the energy sector differentiate between a Biden and Trump presidency? For more, we want to bring in our very own Ines Ferre. Hey, Ines.
Hey, Shauna, that's right. And analysts are broadly agreeing that if Trump were to win the presidency, you'd see more permitting, more drilling, weakening of EPA rulemaking, more leasing on federal lands, a clear path for export terminal permitting of liquefied natural gas. The freezing of licenses for projects is something that Trump has stated he will undo pretty much on day one. Now, most analysts believe that energy equities will go up under a Trump 2.0 scenario, with one strategist telling me energy stocks will benefit as investors bid up the terminal value. So, for example, oil doesn't become obsolete as quickly as some had feared. As a result, the entire fossil fuel complex is likely to get a lift should Trump win the election. Now, do keep in mind, though, a point that Stifel analysts brought up. According to Bloomberg data, during Trump's administration, clean energy outperformed traditional energy. Meanwhile, clean energy underperformed traditional energy during Biden's administration. You really have to take into consideration what was going on at the time when Trump was in office, lower interest rates, the pandemic. Remember that oil went sub-zero during his presidency as well. And during Biden's administration, Russia invaded Ukraine and oil skyrocketed. Oil companies have seen record profits, by the way, during Biden's presidency. All this to say that Stifel analysts actually believe that based on past performance, the energy sector could benefit from a Biden win. Guys.
All right, Ines, thank you so much for your time. We really appreciate it. Thank you. For more on the energy sector, as well as his thoughts on a potential Trump-Vance presidency, we bring in General Wesley Clark. General Clark is the former Supreme Allied Commander for Europe and NATO. He now has his own firm as well. General, thank you so much for coming on this morning. You obviously have extensive experience in the energy and alternative energy fields in particular, so I want to get your take on the EV space. Given what we have heard so far from the Trump-Vance ticket, if they are to enter office again in November, what do you think would be the single biggest impact on the EV sector in particular?
Oh, I think there's no doubt that we're going to relax permitting. There'll be more opportunities for exploration in the United States and waters offshore of the United States. We expect to see energy hydrocarbon production go up in the United States and more exports of LNG. So there's a lot of LNG terminals out there waiting permitting. Some have been permitted, can't get financed because they don't have long-term contracts overseas. Somehow, though, President Trump's going to have to balance this America first, put up the tariff wall with the desire to export LNG. Countries are going to trade off just like he is. So there's a lot of transactions here that will be looked at very closely.
General Clark, I'm curious what your conversations have been like, just given the uncertainty, given the fact that we've heard from Senator Vance and also former President Donald Trump that they do want to repeal some of that climate policy. How are businesses adjusting now in preparation for that potential outcome?
Well, it's not clear that there's that much adjustment because I think businesses have seen through the politics of this. When you look at the temperature across the United States today, you look at the flooding in Florida and Texas and so forth, businesses understand reality in ways that politicians don't. So yes, businesses will take advantage of tax credits if they're offered. Businesses will take advantage of other government incentives, but businesses also understand reality. They have a longer term perspective in many cases than the political advocates of particular positions. So globally, businesses are moving to recognize the reality of climate change. Whether this country does it and recognizes it politically or not, our businesses are. So they are making appropriate adjustments for the fact that we're going to deal with higher temperatures, more difficult insurance policies, more flood events, more severe storms, et cetera. You can't deny it. So they'll go and sway back and forth with the politics of the current administration or the next administration, but they're looking at realities.
General, you say you can't deny it, but we do hear denial from certain individuals within the Trump campaign. What concerns you about that if Trump does enter office again come November?
I think, the country needs to really look at hard science. And even companies like Exxon 50 years ago recognized the contribution of carbon emissions to climate change. They just didn't want to admit it for business purposes. So when you're looking at this sector, we've got to, you can say you're a climate denier, you can ask for contributions from hydrocarbon companies. I'm in that business. I know how it works. But the reality is that this is the time we should maximize America's hydrocarbon strength and use those resources gained to transition to a more carbon neutral policy as soon as possible.
And General, before we let you go, we only have about a minute here, but I'm curious what you're hearing from NATO members, just in terms of what a Trump presidency will mean for the U.S.'s stability, how you see that impacting foreign policy.
Well, they're shaking in their boots, to be honest. They don't understand exactly everything that Mr. Trump's going to do. They know he's a little unpredictable, but he's been very, very clear. He wants to cut U.S. support in NATO. He's made these provocative statements about inviting Mr. Putin in to do what he wants with members who don't contribute 2% of their GDP. It completely undercuts the concept of deterrence. And he's talking about trying to solve Ukraine, I guess, by forcing the Ukrainians to concede territory to Mr. Putin. So, yes, Europe's highly concerned.
General, we can't thank you enough for your time this morning. We really appreciate you coming on. That was General Wesley Clark, Wesley K. Clark and Associates, Chairman and CEO, as well as several other accolades here. Thank you.
Thank you.
Coming up here, we've got Wealth. It's dedicated to all of your personal finance needs. Our very own Alexandra Canal is going to have you right here for the next hour, so stay tuned.
Welcome to Wealth. I'm Alexandra Canal, filling in for Brad Smith, and this is Yahoo Finance's guide to building your financial footprint. Our community of experts will give you the resources, tools, tips, and tricks you need to know to grow your money. On today's show, Managing Your Money, we're going to talk about what investors should do with tech stocks as Wall Street tracks a broadening out of the markets. And Insurance 101, we're going to talk to an insurance strategist about auto and homeowner rates and when consumers could possibly see some relief. Plus, the Biden administration is canceling another $1 billion of student debt. Find out if you qualify. And Yahoo Finance's Julie Hyman will speak with Blackstone President and Chief Operating Officer Jonathan Gray. That's coming up at 11:30 a.m. Eastern. But up first, the Nasdaq lower once again today, this coming after the index suffered its worst day since December of 2022. Mega cap tech stocks like Nvidia have taken a hit in the last few days, leading the whole sector lower in its wake. And we're seeing some rotation into small caps, with the Russell 2000 up around 6% in the last 5 trading days. So how should retail investors price in these market moves? Joining me now is Sam Stovall, CFRA Research Chief Investment Strategist. Thanks so much for joining us today. Look, we've been talking a lot on Yahoo Finance about the rotation that we're seeing out of tech and into some areas like small caps. What are you bullish on, and what do you think is undervalued at this point?
Well, good to talk to you, Alexandra. I think investors right now, first off, should make sure that they are not going to allow their emotions to become their portfolio's worst enemy. Yes, we are seeing a rotation away from the tech stocks, these mega caps that had been leading the market over the last 2 years. But I think that's actually quite natural and necessary. Now we are rotating into what I call the also-rans. And these are the groups that did not do well when tech was doing so well. But because of this participation expansion, that's actually positive for equities, because now more and more of the constituents within the broader market are participating in the advance. So I would say to investors, if you feel like you have to do something, simply hit the rebalance button on your 401k. take a look at the all of the stocks and ETFs that you have to see what exposure you do have to technology. In the S&P 500, it's a little more than 33%. On an equal weighted basis, it's about half that. So just make sure you don't have way more exposure to tech stocks than you have in the broader market.
So looking more broadly ahead here, Sam, do you think that this pullback that we're seeing in tech, could that signal a potential correction to come down the line, or at least more volatility in the short term? And if so, how can investors protect themselves?
Yes, I do think that we're going to see more volatility. We are in traditionally the challenging third quarter. That is the worst of the 4 quarters on average in terms of price change and volatility. And September is the worst month of the year on average, falling more frequently than it rises. But I like to say that forewarned is forearmed. If you know that we are heading into a rough patch, then you're likely to sit on your hands and do nothing. What I remind investors is that we have had 65 pullbacks. Those are declines of 5 to 10% since World War II. Amazingly, it's only taken a month and a half on average to get back to break even from such declines. We've had 25 corrections, declines of 10 to 20%. And amazingly, it's only taken 4 months to get back to break even. So by the time you worked yourself up into a frenzy and convinced your advisor to lighten up on equities, the market is probably already on its way back to full recovery.
So the long-term play there for investors. And when you think about tech, should you avoid it at this point? Are you too late to get into it because of the recent rally that we've had? Or do you think that this is still a viable sector for investors that are just getting into the game?
We do believe that tech is a viable sector. And actually, what you could do is just wait for some softness in prices in the weeks ahead, and then use that as a better buying opportunity. And the reason that we still like it longer term is because of the earnings growth that we see ahead. For 2025, we are looking for a little less than 15% growth for the overall market, but more than 20% growth for the technology sector, and a similar kind of outperformance in terms of earnings growth in 2026. And come the latter part of this year, a lot of the analysts will be focusing on 2026 expectations, and most of the decisions to buy or sell will be based on those forecasts.
And we have Netflix kicking off some of those big tech earnings later this afternoon. And I want to talk a little bit about the jobless claims data, because we're seeing a continuation of this softness in the labor market. How do you think this plays into the narrative for the Fed that they could potentially be cutting rates?
Well, I think it adds, bolsters the conviction that investors have had over the last week and a half that triggered this rotation into the also-rans, the interest sensitives, the mid and small cap stocks, because there is an increased likelihood that the Fed will be cutting interest rates starting in September. And let's remember that in every election year since 1990, except for 2012, the Fed has either raised or lowered interest rates before the election. So given the opportunity to prove that they are independent, they will do so. And I think lower rates will continue to support and propel equity prices.
A lot to look forward to in the next coming months. Thank you so much, Sam Stovall, CFRA Research Chief Investment Strategist.
My pleasure.
Well, as we were just discussing, we got a fresh read on the labor market this morning. 243,000 Americans applied for unemployment benefits last week, matching a near one-year high. That's according to the U.S. Department of Labor. New claims rose by 20,000 in the past 7 days. For more on what this means is our very own Madison Mills. So more weakness, Maddie, moving forward, especially the data that we got today.
Yeah, it was definitely giving an indication of, oh no, what's happening in the job market. We're seeing more unemployment, scary, spooky, bad, but you guys are smart. You watch Yahoo Finance, you read our coverage, so you know that there's actually some news under the hood that makes it look not so tough. I'm going to run through some of that now. So initial claims coming in, like you said, Allie, higher than expected for the week ending July 13th. It was a jump of 20,000 here, but Bloomberg Economics saying that 13,000 of those that uptick of jobless claims was driven by seasonal factors. So that's not likely to stick around and mean anything about a sickness within the broader jobs market. So what are those seasonal factors? Earlier on our programming, we had Stephanie Roth from Wolf Research talking about how there's a climate change impact going on here, a climate impact rather, hurricane season potentially leading to some unemployment numbers going up across the country here. We also know that over the summer, some of the automakers do this seasonal retooling, which leads to these auto plants shutting down. And that led to an uptick in a lot of areas that are driven by the auto space. For example, Michigan, New York, and Indiana, all of those were the biggest states that saw the biggest uptick. And that is driven primarily by the auto space when you look under the hood in this data here. But it is not, the time to just totally slough off concerns about the job market. We had President of the Federal Reserve Bank of Chicago, Austin Goolsbee, on our program with Jennifer Schomburger earlier today. And he did say that the job market, the labor market, is something to take a look at, that the Fed is watching it. They are concerned about the jobs data and unemployment ticking above that 4 handle in the last jobs print coming in at 4.1%. But even that could be good news, because if the Federal Reserve does cut interest rates, that could lead to CEOs being less freaked out, and that could mean less layoffs to come. So good news even when there's bad news.
Yeah, and I'm reading through some reaction from Wall Street. Goldman Sachs saying we may be approaching an inflection point at which further softening in labor demand results in a bigger and much less welcome increase in unemployment. And I feel like the unemployment rate, that's been something that the Fed has been super focused on, a lot of these Fed officials as well. Do you think if we see an unemployment rate that goes significantly above 4%, could that potentially signal a hard landing to come? What does this say about really the future of this economy and the consumers within it?
Yeah, well, if we go above 4% for 3 months in a row, that could trigger something called the SOM rule, which is a fancy thing that economists look at to basically indicate that this actually is bad news within the labor market. And that would be an indicator that the Fed stayed high for too long and that we are seeing a little bit of a hard landing. But even Claudia Sahm herself, who created that rule, has said that this is just a very unique market and that some of the weakness that we're seeing, it's coming from white collar jobs, for example. It's not coming from the pockets of this economy that are going to show up in that broader headline data. And so that could even be an indication that there's just some murkiness in this data that's not necessarily being as clear as possible for the Federal Reserve moving forward. We have guest after guest coming on and saying that the Fed has engineered the soft landing that they've been looking for. And you can see that in their dual mandate. They look at not just the labor market, but also inflation. And we are seeing inflation data getting closer and closer to 2%. But the big question will be what that data looks like come the rate cut that we've been teasing out for years and years.
History not really on our side with this current environment right now. But Maddie, great reporting. Thank you so much for taking the time.
Thanks.
Coming up, Domino's Pizza reporting earnings today. We break down what the report says about consumer spending. And don't miss Yahoo Finance's Julie Hyman. She's going to be speaking with Blackstone President and Chief Operating Officer Jonathan Gray. That's coming up at 11:30 a.m. Eastern. Domino shares falling today, down a whopping 13%. It's actually the #1 ticker on the Yahoo Finance homepage, and this comes after the pizza giant modestly missed its same-store sales expectations and cut its international unit guidance. Yahoo Finance's Brooke DePalma joins us now to discuss. Brooke, what the heck is going on here? I'm a Domino's fan. I like the flatbread, cheesy crust pizza. What's happening?
There's a lot going on here, and investors are certainly weighing in on that pullback in international growth guidance. That's really driving that decline today. And one analyst saying that investors are fearing that that pullback will then impact international sales growth in the near term over the next fiscal year. And primarily with this pullback, one of their major franchisee operators, Domino's Pizza Enterprising, is closing underperforming stores in Japan and France. So investors really weighing in on that. But if you take a closer look at what's going on here in the U.S. when it comes to the state of the U.S. consumer, we've been saying this over and over again, we continue to see a very value-conscious consumer, one that is really doubling down on where they're going and where they're exactly putting their bucks. On the call, CEO Russell Weiner weighed in on how the company is performing in this environment.
We've grown orders in our delivery business, our carryout business, every income cohort. We haven't talked about international, but we've grown order count in international. And so that's what's going on in an economy where folks are kind of maybe struggling to decide what to buy.
And really what we're seeing here is that value-conscious consumer looking for the best bang for their buck. But what will be a real indicator about how this pizza chain industry is doing is when Yum Brands Pizza Hut comes out. We want to hear from Papa John's earnings to see if this is really an overall trend, or even these pizza chains that tend to do well in this environment where consumers are looking to get the best bang for their buck for their family is seeing a pullback as well.
So you were just saying how you were listening to the call. What did management say about the path forward here?
Yeah, well, there's two incremental catalysts that the company's really looking at, and that's their big partnership with Uber Eats. They announced that last year, and they have an exclusive deal with Uber Eats through Q1 of next year. So many investors are really hoping that they'll eventually go with other third-party delivery services like a DoorDash. Uber Eats now make up 1.9% of total system-wide sales. That number is set to track to 3% by the end of the year. Another catalyst here is loyalty. We know that loyalty tends to cater to this low-income consumer that's really struggling right now. Loyalty for transactions are up 2 times year over year. And also customers are really responding well to that $5 offering to get points. Domino's dropped that down from $10 to get points. So really lower income consumers and income cohorts alike really playing into that loyalty options as well.
I love a good loyalty program.
Love a good deal.
Racking up those points. Brooke DePalma, thank you so much for taking the time. And tune in on Tuesday during Wealth. Brooke will actually be speaking with Russell Weiner, CEO of Domino's, for a deeper dive on the future of the pizza giant. The cost of auto insurance is on the rise, with prices up 19.5% this year. That's according to the latest consumer inflation report for the month of June. And unfortunately for our wallets, it might be getting even higher. Here to discuss the state of the insurance sector is Tim Zawacki, S&P Global Market Intelligence Insurance Sector Strategist. Tim, thank you so much for joining us. And look, you pointed out CPI is a lagging indicator when it comes to how much Americans are spending on insurance. But your rate filings data showed some evidence of, quote, continued sizable increases to come. A little ominous there.
That's correct.
How significant is that?
It's significant, but it's difficult to capture what's happening in the auto insurance business at the local level through these national statistics. So in some states, the rate increases that people were seeing back in 2022 and 2021 were either non-existent or very small. And in those states, that's where we expect to see the large rate increases still coming through and serving as a driver of that very high CPI print. Now, the CPI for motor vehicle insurance did peak earlier this year at more than 22%. That was the highest level since 1976. We don't expect to see that revisited in this cycle, and we expect that to continue to come down because, as you mentioned, it is a lagging indicator of what companies are actually doing today and what they're seeing today in their results.
So you expect it to come down. When exactly can we see some of that relief?
So I think for most people, it's probably going to be when they actually open up their bill or open up the PDF that comes every 6 months in their inbox. It's probably going to be 2025 before that relief actually starts to show up in terms of the absence of rate increases, or in some cases, we have started to see some rate decreases. But again, the rate decreases that we are seeing are coming in places where there were very significant rate increases, and the companies may have just overshot a bit on those rate increases.
Mm-hmm. And how's demand holding up amid these high rates? Are you seeing some folks just simply not paying for homeowners insurance, not paying for autos insurance because they can't afford it?
Well, I have seen on web searches a lot of different, don't pay for auto insurance. You're paying too much for auto insurance. You can do without home insurance. And I would say to the consumers out there that both of those options in many cases aren't available to you. In many states, most states, auto insurance is required at least at a minimum level. And for homeowners, most people with a mortgage will be required to maintain homeowners insurance. And the criteria for that tends to be pretty strict in terms of the amount of coverage and the type of company you're purchasing it from. So the idea of going without coverage is not really viable. And even if it were viable, it wouldn't be advisable, just given the extent to which we've seen weather-related losses come up. Hailstorms do tremendous amount of damage to things like roofs, both of vehicles and of homes. And if you were to pull back coverage, you'd leave yourself exposed to some pretty significant financial hits from a really severe storm. Think of if a storm hits your house and your car is parked out in the driveway, and there's softball-sized hail. You're looking at tens of thousands of dollars of damage to your home and your vehicle. So purchasing adequate amounts of insurance coverage, as painful as it may be today, is really the best way forward.
Mm-hmm. And just to take a step back here so our viewers understand, why have insurance rates been so high and so sticky?
So this is really one of the effects that the post-COVID inflationary period has really had a huge impact. Think about labor cost. The skilled labor it's required to rebuild a home or to do significant repairs on a vehicle, those costs have just shot up in the aftermath of the pandemic. And you layer on top of that the building materials for homes going way up in prices. There was a spike in lumber back in 2021. Used car prices, while they've leveled out and declined from their peak, they're still well above where they were before the pandemic in 2019. So this is something that is really, I think the companies have struggled with it. They've seen the worst financial results in the auto and the home business that they've experienced in more than 2 decades. And it's taken quite a number of rate increases to really catch up to the loss costs that these companies have been experiencing. And that's unfortunate for the consumer because obviously you're seeing those bills, the auto insurance bill usually twice a year and the homeowners once per year, and 20% is a painful number to swallow when you have all sorts of other inflationary prices in your daily lives.
And unfortunately, at least according to your crystal ball, won't really see relief until 2025.
I think relief for homeowners may not be coming in 2025. I think for auto insurance, it's definitely in the cards. Homeowners insurance, I think high rates are here to stay.
That's not great. That's not, you know what, but you know what, Tim? Thank you so much for coming on and sharing this bleak outlook with us. Tim Sawacki, S&P Global Market Intelligence Insurance Sector Strategist. We'll have to get you back on when hopefully, potentially, rates come back down. Thanks again.
Thanks so much.
Turning now to your money in your bank account. My colleague Brad Smith spoke with Yahoo Finance's Molly Moorhead about how much you should keep in your checking account. Take a look.
Well, the median household's checking account balance is $2,800. That's according to the Federal Reserve Board. But how much money should you keep in your checking account? There's no hard and fast rule, but stowing away enough cash is crucial to be able to handle any surprise bills that life throws at you. To discuss this further, we've got our very own Molly Moorhead here in studio with us. So, Molly, $2,800 is what the Federal Reserve is seeing. What should the real number be that most people can set at least as an ideal target?
Well, as you can imagine, there's not really a number that applies to everyone. It's all in how much are your bills, your income, your spending habits. And so the good couple of rules to follow are you want enough that you'll never be overdrawn and enough that you have a cushion. And the cushion, if you can do it, is 2 months worth of your expenses. So if you have $4,000 in bills every month, if you can keep $8,000, that's good. If you can keep $6,000, that's good. But you just want to know that you're never getting too close to zero.
Absolutely. So once you have the right amount for you in that account, that 2 months of all-in expenses, what do you do with the extra?
Yeah, so the reason you don't want to keep it all in checking is that it's not making any money for you. So you want to put it in something that's going to be interest-bearing, a high-yield savings account. Those are paying like 5% right now, a CD, a money market account. Those are all good options that are liquid. And then we always want to be socking money away for retirement. So if you have a regular income every month, a salary, and you get that healthy amount in your checking account, then put it away for retirement. That's always a good play.
Absolutely. Molly Moorhead, thanks so much for breaking this down for us. Joining us here in studio, Yahoo Finance's own.
Welcome back to Yahoo Finance. I'm Julie Hyman. Shares of alternative asset management giant Blackstone rising after it released second quarter earnings. The firm did miss on profit expectations for the quarter, but it did increase the pace of its investment activity. Blackstone seeing more than $39 billion in inflows and deploying nearly $34 billion in the quarter. That's a 70% plus jump from the prior year. Here with more, Blackstone President and Chief Operating Officer Jonathan Gray. John, it's good to see you. Thanks for joining us.
Great to be with you, Julie.
So as I mentioned, and specifically here, distributable income did miss some estimates. It was up 3% year over year, but you did express some optimism on the call about the second half of the year real estate in particular, perhaps seeing a turn, but in general, you seem pretty optimistic. I know you don't give specific financial targets going forward, but what kind of color can you give us? What kind of forecast can you give us about what you're seeing from here?
Well, I just start with the quarter, and it was another strong one for us because the forward indicators were so positive. You hit on them. We deployed a lot of capital. If you include what we committed to, it was more than $50 billion, the highest in 2 years. And that reflected that improving market that's out there. Cost of capital has come down as inflation's come down. Expectations are coming down for rates, and we're seeing a pickup in transaction activity, which is very helpful when you think about your question on the back half of the year. We also have made a conscious choice to lean in to invest before the all clear sign, where we think you make the best investment decisions and get the highest returns doing this early. And that's been very important. And of course, we raised a lot of capital in the quarter as well. But I think the really important thing is we're doing a terrific job for our investors, focusing in some of these big sectors like digital infrastructure, the power that goes with it, India, private credit, where we can deliver terrific returns. And we think it'll be a very good environment here moving forward because that cost of capital is coming down. The Fed will cut rates. We're going to continue investing into that. And we're excited to sort of put behind us the last 2+ years, which have been tougher.
And speaking about when the Fed is going to cut rates, I want to bring in a little bit of an interview that we had earlier this morning. Yahoo Finance's Jennifer Schonberger spoke to Chicago Fed President Austin Goolsbee, and she asked him if we have the basis for a rate cut right now. I want to play for you how he answered that question.
You know, I don't like tying our hands ahead of time when we're going to get a bunch of data before the next meeting, and I like to hear what the views are of the other participants of the FOMC. So I'm not going to say this number says we should do X at the next meeting, but I will say the through line. Yeah, this is what the path to 2% looks like.
So this is what the path to 2% looks like. He sounds like he's open to a cut at the very least. You talked about the all clear signal. Is that first rate cut, is that the all clear signal? And do you think it is coming in September?
I do think that as the Fed cuts rates, as we move out of this tightening period, that will give investors more confidence. It will make the cost of debt capital lower. It'll help transaction activity. I think it'll help the IPO market. And I do think the Fed is getting more and more air cover to cut rates. The Fed's medicine is working. What we're seeing in the economy is a labor market that's not as tight as it was certainly a year and 2 years ago. We survey our portfolio company CEOs. They said this quarter hiring was the easiest that it's been in 3+ years. We asked them about wage expectations going forward. That's down to the lowest level that it's been in a number of years as well. And in the rental housing area, the shelter costs in the Fed CPI data still seems to lag what's happening on the ground. So I do think they're going to get better numbers. They may not all come in a straight line, but the path of travel on inflation is downward. That should lead the Fed to be able to cut rates. I think they'll do it gradually. They don't want to see inflation pick back up, but that will give the markets confidence that we're moving out of this tighter credit environment to a more favorable environment. And that is better for asset prices and asset values and transaction activity, and of course, better for our business.
Well, as you said, we've already seen some of that move, at least, right? With the cost of capital coming down, equity markets have been flying on these expectations that the Fed cuts are coming. So when they actually come, how much do you think is already then priced into the markets, whether we're talking about funding or real estate or equities for that matter?
Well, the market does discount things, particularly the public equity markets, but the private markets, which tend to rely on more debt capital, the actual impact of cutting rates is very helpful. And it just makes financing a new private equity transaction easier. It makes doing real estate investing and borrowing money easier. It also has another impact from a fundraising standpoint, which is today you earn a lot of money leaving your money in a money market account. as the returns on cash come down, it forces investors to reevaluate and move further out the risk curve. And again, that's good for our business with institutional investors and with individual investors. So I think it has a lot of beneficial factors. It puts less stress on the system. It allows people to invest more capital. Return expectations come down for that capital. There are lots of positives for lower cost of capital, and it won't happen overnight, but as it works its way through the system, it should be helpful. And I think the risk we have, of course, is, we've seen unemployment go from 3.4 to 4.1%. These high short-term rates are having an impact. They're taking a bit of a bite, and that should slow down a bit too if the Fed starts to move towards easing.
I want to ask you about AI because you guys are very heavily invested in AI. You talked a lot about it on the call, your investments in data centers and other ways at getting at that theme. We've heard a little bit of skepticism lately from some quarters that not only has the AI trade perhaps gotten ahead of its skis, but that this enormous expectation for deployment is sort of ahead of itself as well, that we don't know exactly still how corporations are going to be using AI, et cetera. So are you still as confident as you've ever been? Do you think the timeline at all has shifted? What's your reaction to some of this skepticism?
We see AI as transformative technology. The ability for these machines to process, obviously, language and videos, sound, and that will have a powerful impact on how we live and how we work. It'll help companies in terms of customer engagement. It will help companies on the creative side as tools to develop software. To us, it seems very powerful. It could help, obviously, in the robotics area. We think there are going to be a lot of changes. Some of that may take a bit of time. But our focus has really been on building the backbone, the infrastructure of the 21st century, which is the data centers and the power that goes with it. And so if you look at what we're doing, we've acquired and invested in the fastest growing data center company in the world in QTS, which is in our infrastructure business and our real estate business. We've partnered with Digital Realty. We just did a $7.5 billion financing we led for CoreWeave, who's an AI infrastructure business. We invested this week in a company, TriStar, that does backup power generation, a bunch of it for data centers. And then on the power side, invest in utilities, renewables development, pipelines, the whole infrastructure, because power demand is really going up, much of it due to this AI and digital infrastructure demand. 40% anticipated power increase in the US over the next decade versus flat in the previous decade. So I think this will come. What the profitability will be, which applications will win, I think that is uncertain. But I think the path here towards more AI, more compute power, and therefore more infrastructure needed is the way to go. And as a firm, we're all in on that. And I would also say our private credit business, what we do for our insurance clients with investment grade private credit, can power a lot of this from the financing side too. So it's a huge opportunity for us, and we're focused on it. And so far, it's delivering very positive results for our customers.
I want to switch gears and ask you about politics a little bit. I know this is something you've already been talking somewhat about. Vice presidential candidate J.D. Vance saying last night at the RNC that the GOP, in his words, won't cater to Wall Street. He sort of had some fiery rhetoric there. He talked about Wall Street barons who crashed the economy. Do you just view that as rhetoric or something that you and your peers on Wall Street sort of need to be concerned about? And if so, how do you prepare for what could be a more adversarial environment?
Well, I just start by saying as a firm over 40 years, we've operated in red environments and blue environments, purple environments, and we focused on delivering great returns. And that's what we've been able to do through all those different environments. If there is a movement here towards the Republican side, I'm confident we'll navigate that as well, too. I would say, what are the major impacts, the areas of focus? First would be the regulatory environment. I think will look different, particularly in antitrust around M&A activity. I think on the energy side, I believe we'll see, much more support for hydrocarbons, although renewables will still be very important because of the power needs I discussed earlier. And then there is, some focus on tariffs and what that will mean for manufacturing businesses. So as I said, red, blue, we'll manage to do just fine. And I think everybody wants to see this economy grow, and that's a positive for us and our business.
And finally, John, historically, you have been a Democratic donor. And so I just wanted to get your quick thoughts on what's happening in the Democratic Party right now. A lot of public turmoil about who will sit atop the ticket. How do you think the party moves forward from that? And also, what does all this mean for the down ballot races?
I'm going to leave the down ballot races to the pundits on what happens here. Obviously, there's a lot of focus on the president, what he's going to do. He is a good man. I think he's been a wonderful public servant. And ultimately, this is going to be his decision. As Speaker Pelosi has said, he got the vast majority of the votes in the primary. But there is a pretty significant physical toll of this job, and he's considering that. And so if he does decide to not continue forward, then I think, the Democratic leadership will have to make a decision on what's the best path to get the right nominee. Or if he stays, then we know what that will look like. So like everybody else, I'm going to watch and wait and see what happens here. I think regardless, this country will find its way forward.
John, thanks a lot for your time. I appreciate it. Blackstone President and Chief Operating Officer John Gray. Thanks.
Thank you so much.
We've got much more on wealth after the break. You're watching Yahoo Finance.
The Biden administration announcing a brand new round of student debt forgiveness that could cancel $1.2 billion in student debt. That's part of the Public Service Loan Forgiveness Program. Our own Rochelle Akufo is here with more. Rochelle?
Hi, good to see you, Ali. So let's start with the three things that you need to know. Who qualifies? How do you apply? And how is this different from other student loan forgiveness efforts? So first, eligibility. Now, this applies to certain not-for-profit and government workers who can get their federal student loans cancelled after 10 years of on-time payments. That's 120 payments. Now, the PSLF was signed into law actually back in 2007 under then-President George W. Bush. But the rejection rate was notoriously high. Anything from spelling errors to gathering physical signatures and EIN numbers from every previous employer To fill out some of these certifications, those were just some of the hurdles that really limited the acceptance rate. But now you can apply online in a streamlined application with the required signatures from borrowers and employers digitally, and that's using the tools at studentaid.gov/PSLF. Now, lastly, how is this different? Well, Education Secretary Miguel Cardona calls these improvements long overdue and gives public servants the financial breathing room they were promised. Of course, you'll recall the Supreme Court struck down President Biden's attempt at the sweeping loan forgiveness legislation last summer. But now the administration is maximizing some of these existing programs to reach that effort. In a statement, the Education Department says today's announcement brings the total loan forgiveness approved by the Biden-Harris administration to $168.5 billion for 4.76 million Americans, which includes $69.2 billion for 946,000 million borrowers through PSLF. Interesting that they do note that up until this point, only 7,000 people were able to get payment through this because of all this red tape that they had to jump through, Ali.
Yeah, I remember all the red tape, and we actually had a guest on a few months ago talking about this. But then moving on to the Republican side, the Republican National Convention is ongoing this week. Has the Trump-Vance campaign laid out any of their student debt policies?
So there hasn't been in focus right now at the convention, but both former President Trump and his VP pick, J.D. Vance, have been very clear in previous comments that student loan debt should not be cancelled. Now, Trump was already calling for cuts to the Education Department's debt relief programs, and that includes PSLF, as well as wanting to disband the Education Department itself. He also called the Biden administration's attempts at student loan forgiveness a vile political stunt just last month at a rally. Meanwhile, for Vance, he actually tweeted in 2022 that, quote, "Forgiving student debt is a massive windfall to the rich, to the college educated, and most of all to the corrupt university administrators of America. No bailouts for a corrupt system. Republicans must fight this with every ounce of our energy and power." Now, he is a Yale Law graduate himself, and he did actually support in May of this year to discharge parents' federal family education loans. Now, this is very specific. This is if parents took out loans for a child who develops a total and permanent disability. So some nuances there, but both firmly believe in not canceling student debt there, Ali.
Yeah, going to be a big discussion point heading into November. Thank you so much, Rochelle. Well, summer travel is heating up to be one of the busiest ever. Nearly 3 million flights are set to depart from U.S. airports between June and August of this year, carrying enough seats for more than 324 million passengers. That's according to new data from travel platform Hopper. Here to weigh in on the travel trends and strong demand we're seeing this summer is Haley Berg, Hopper lead economist. Haley, as we've been talking about, a lot of demand, but with more demand usually comes more disruption. So what are your tips for Americans who want to travel maybe with a little less baggage, a little less stress this summer?
You're right. Even though summer is the busiest time of year, it is also the time of year we see the highest disruption rates. Good news, though, this summer disruption rates have stayed relatively flat into the peak summer months. Only about 23% of flights delayed on departure from U.S. airports, and that's down 17% from last year. So what we suggest is planning ahead. If you haven't booked yet, book the first flight of the day. You're less likely to get caught in those domino effect delays. Add a flight disruption assistance product if it's offered to you. We have them on the Hopper app, many other platforms. And most of all, get the information you need. Sign up for notifications from your airline's app, from the airport. Information is the biggest way you can get ahead of those long lines if you are disrupted.
And what kind of disruptions are most typical during the summer months? And are there certain areas of the country or even the world that experience more disruption than others?
Yes. Weather is the biggest driver of those pockets of disruption. Take Houston, for example. They were hit by bad weather as a result of Beryl, and we saw a 40 to 50% increase in cancellation rates, as well as delays around the country because of flights that were scheduled to leave from a Houston airport and then didn't arrive to take passengers on from that next city. So we do see pockets of disruption driven by weather, but a hot spot during the summer is Europe. Typically, European airports are overrun by travelers from all over the world, and some don't have the capacity to handle that influx of passengers. So take Charles de Gaulle in Paris. It's going to be a busy one with the Olympics this summer. They have the worst disruption rate on record for summer flights this year and last. So that's an example of one where you just have to get there early and prepare for those disruptions.
And we're seeing a magnitude of pricing pressure from some of these top airlines. United, for example, gave a grim earnings outlook, saying they've had to actually cut prices in order to fill seats. So given that, is now the time to buy your future travel for some of these airlines?
Right now is absolutely the best time to book travel, especially if you are thinking about adding a trip in September or October. Seasonally, we see prices drop. If you're departing in June, July, or August, you'll pay about 30 to 40% more for your trip than if you take that same trip in September and October. Add on to that the surplus in supply we're seeing in the market that is driving prices down this year compared to previous years and even pre-pandemic. It's an incredible time to book those vacations for American travelers, especially if you're thinking about what we call a bucket list vacation, a trip to Europe, a trip to Asia, South America, where you'll be paying over $1,000 for your airfare. Now's the time to book it. Those prices are incredibly low.
All right, I'm going to be using these tips to book my next vacation. Hopefully it's a bucket list vacation. Haley Berg, Hopper Lead Economist, thank you so much for joining us.
Great to be with you as always.
Coming up, housing hurdles. We talk about the state of the housing market as mortgage rates remain elevated. That's next. As mortgage rates continue to remain high, the housing market remains largely unaffordable for many Americans. And one trickle-down effect of that reality is that realtors continue to struggle. Last year's median gross income for realtors was just below $56,000. That is actually a decrease from 2022. For more on the current state of the real estate market, as well as the realities of breaking into the real estate business, is Jessica Markowski, Sirhan real estate agent and star of Netflix's Owning Manhattan. Jessica, thank you so much for joining us. I'm obsessed with the show.
Good. Did you finish it?
I did finish it. I binged it right away. But
oh, good, good. I'm happy to hear that.
Something that came for me for the show, and this was filmed in 2021, right? Yes. Shortly after the pandemic. Yes. And we remain in this very wonky market. Interest rates are high, inventory is low. What are you hearing from buyers and sellers? And is it possible to even time this market right now?
Yeah, it's kind of to the point of what Jonathan Gray just said from Blackstone. We're expecting interest rates to drop. I think everyone's really optimistic. There's not a lot of inventory on the market right now, but, there's still a lot of great inventory out there. But we're hoping that come September, we're going to have like a little decrease. Not to say that, I have clients who are all cash buyers, right? But, when people come with a mortgage, they're waiting for a drop.
Got it. So cash is king, which
Cash is always king.
Always king,
Always king.
which we consistently hear. One of the other big things that stuck out to me was the negotiating process here, because you guys are selling these multi-million-dollar homes. These buyers are billionaires, yet they're still holding firm with their negotiating. So when you're advising clients, or do you have any tips when it comes to home buyers that are in that negotiating process?
Yeah, I mean, I think that's why they hire us, right? Like, we find this to be a beautiful craft, and we've figured out a science to how we're negotiating. And, you know, we're that middleman to really help our client to get the best deal possible. So that's why we're in between the transaction.
And in the beginning, we were just talking about the life of a realtor and how there are certainly some struggles. We're seeing that the people that are choosing to be realtors decline. They only make about $50,000 a year. How can you be successful in this career path?
Yeah, I mean, you have to know going into real estate, like the first year is always the hardest. I know for myself, I know for my colleagues, definitely the first year is hard, but if you stay persistent, just like when you work out, if you really like find this to be like a routine, you could become very good at it, but it doesn't come overnight. You know, it's not like an overnight success story. It's the work, the grind, the persistency allows you to become successful.
And what are the biggest struggles that you face and you've seen some of your colleagues face in this career?
There's a lot of ups and downs, right? So, you know, we don't focus on that. Luckily on the show, we really like try and capture the hard, bad, good, and ugly, which is in the trailer too, which is something that I said. You know, it's a grind, it's hard, but, you know, we don't really capture those hard moments, but they exist 50% of the time too.
And I'm hearing more and more of people wanting to go into real estate as a second career of sorts, maybe a side hustle of sorts. Is that something that you see that's common? And can you make money and be successful doing that if you're not dedicating 100% of your time?
I think you have to dedicate anything in life. You can't go like half foot in. I really think if you really want to pursue the career in real estate or any job for that matter, you have to put all your eggs into that basket to be successful. There are people who do side hustles for sure, but to be very good at it, you have to put everything aside and focus on one path.
And you actually transitioned from a career in fashion to real estate. I'm sure there's a lot of people out there that are curious about making a career transition, a career pivot. What advice would you have for them?
I would say do it. If you really want to switch, you're tired of the job you've had for 10 years, it's okay to switch it. The skills that you've acquired from previous jobs that you've had, you could easily apply it to real estate or any other industry. You know, you're still a valuable asset to any other company you join. So I'm for it.
Yeah, love it. And finally, I want to talk about social media.
Yeah.
You are really big on social media. You use it to promote your work. How much is social media going to play a part in helping people find homes?
Sure. You know, luckily at Serhant, we really strive for social media. It's probably one of the reasons why Ryan really wanted me to join his company. Prior to real estate, I was a content creator and I worked with Kim Kardashian on an app called Screenshot. So I really believed in social media and branding and spreading awareness through social media. And Serhant's really good at content and producing high quality images and videos. Just as watching our show Owning Manhattan, like the production value of the show is like jaw dropping. And it's just because like that's what sells. That's what draws you in. That's what hooks you in. And it's probably why you purchased a property, huh?
Oh God, here we go, here we go. It's spilling all my secrets, Jessica.
I shouldn't have said it.
No, but yes, and I found the show really entertaining in that sense. When you're going out there and you're looking to buy homes, it's so different everywhere else, and New York City is such a special place.
It is. New York is always going to be New York.
I love
and that's
it.
why we own Manhattan.
Exactly. Well, Owning Manhattan, if you haven't watched it yet, you can watch it on Netflix. Hopefully we'll have a season 2.
Yes.
Jessica Markowski, thank you so much for joining us.
Thank you so much. Thanks for having me.
Of course, appreciate it. Well, that is it for Wealth. I'm Alexandra Canal. Thank you so much for watching. And stay tuned for Market Domination with Julie Hyman and Josh Lipton. That's coming up at 3 p.m. Eastern. You won't want to miss it.